the honorable guests, faculties, faculty coordinators, students, and my fellow colleagues to the International Finance Conclave, which is based on the theme Financial Resilience and Pandemic, Risks, Opportunities and Policies. The program is organized by the Department of Public Policy and Governance, B.K. School of Professional and Management Studies, Gujarat University. The occasion is graced by speakers and experts from varied fraternities across the globe who will join us and share their ideas on various subtopics. Now, before we proceed further, let us gear up for the anthem of our prestigious Gujarat University, an institution which has given excellence in education to our society since its establishment in 1949. Few of the university's alumni include our Honorable Prime Minister of India, Shri Narendra Modi, Mallika Sarabhai, Kuchipudi and Bharatnatyam dancer, Ashish Nandej, political psychologist and social theorist, and Pankaj Patel, CEO of Cadila.
बुद्धियुतो जहातिह उभे सुकृत दुष्कृते तस्माद्योगाय युज्यस्व योगः कर्मसु कौशलम्। भगवद गीता के द्वितीय अध्याय से यह श्लोकांश योगः कर्मसु कौशलम गुजरात विश्वविद्यालय का सिद्धांत सूत्र एवं ध्येय मंत्र है। इस संगोष्ठी में भी स्वच्छता संबंधी जो कर्मयोग हुआ है उसके फलस्वरूप बेहतर समाज की ओर कई कदम हम आगे बढ़ेंगे, ऐसी हम सबकी भावना है। गुजरात विश्वविद्यालय का गीत प्रस्तुत होगा। गुजरात विश्वविद्यालय का
गुजरात यूनिवर्सिटी आपणी, गुजरात यूनिवर्सिटी आपणी विद्यातणु तपोवन। वंदन अभिनंदन, वंदन अभिनंदन, वंदन अभिनंदन, वंदन अभिनंदन। राष्ट्र चेतना कला साधना खेल भावना विकसे, विश्व मानवी बनी गुजराती विश्व सकल माविल से। स्नेह संत साकारनी साथे देती तू सन्मति, सौना साथ ने संगाथे सौ सिद्ध करे उन्नति। प्रेम बंधुता समानताना पल पल प्रसरे स्पंदन। वंदन अभिनंदन।
B.K. School of Professional and Management Studies is a department of management of the prestigious Gujarat University, established in 1976, and is one of the oldest and eminent B schools of Gujarat state. BK has acquired a unique position in the list of top B schools with its attributes like excellent curriculum, experienced faculties, industrial exposure, strong alumni network, and academia-industry interface. The Department of Public Policy and Governance was established in the year 2020 and is one of its kind programs aimed at improving efficiency and leadership skills among policymakers and administrators while exposing them to topical issues in management. The Department of Public Policy and Governance offers courses like PhD, master courses, certificate and PG diploma courses. The department runs courses including MBA in Public Policy Management, MBA in Event Management, MBA in Defense Management, MBA in Business Economics and Public Finance, PG Diploma in Public Finance and Economics. The department intends to undertake the activities of promoting education, research, training and consultancy in the area of public policy and governance with great pleasure. The department conducts various webinars which bring great knowledge to the students and provide a platform for real-time conversations with our speakers. The department also organizes international conferences that provide significant insights to the participants regarding the trends in the global economy. Here, we present a video portraying life at the institution.
योग कर्मसु कौशलम्.
Meaning, integrating skill in action. This is the motto of the glory of Gujarat. That is, the Gujarat University. Taken from Srimad Bhagavad Gita, this motto truly amplifies the soul of the university. Shining like the crown of the vibrant state of Gujarat, Gujarat University has been following the path of excellence throughout its glorious journey in providing the best quality higher education.
Thank you so much, Dee. Today, as our panel for the International Finance Conclave 2021, we have the honor of having with us Mr. Chirag Gyara, professional of the banking industry, Professor Shantanu Mehta, freelancer, academician, and adjunct faculty in Nirma University, Ms. Niyati Dave, associate at the Supiva Advisory Group Limited, London, United Kingdom, Dr. Ganjaineni Dhananjaya, Dean of MBA at Narayan Engineering College, Nellore, Professor Narayan Baser, faculty at PDPU, Dr. M. Subramaniam, Head of Management Programs, RL Institute of Management Studies, Madurai, Mr. Piyush Gandhi, Senior Vice President, Finance and Accounts, Gift City. Now, I would like to call upon none other than our convener, Dr. Neelam Panchal, Head of the Department of Public Policy and Governance, to extend a warm welcome to our honorable guest. Dr. Neelam Panchal, FTP and SFDP from IIM Ahmedabad, PhD, MPhil, MBA, PGD-IRPM, is an associate professor of ME full-time and evening, the coordinator of PGD-FM and PGD-MOM at the Management Academy of B.K.SCHOOL of Professional and Management Studies, Gujarat University. Ma'am is the chairman of Indian Society Training and Development Ahmedabad National Council member. Ma'am, I welcome you and now over to you.
Good morning, one and all present over here. A warm welcome to all the dignitaries sitting over the other side, across the nation and across the globe. Mr. Piyush Gandhi, Dr. Subramaniam, Professor Shantanu Mehta, Mr. Dhananjay, Dr. Dhananjay, Professor Narayan Bashir, Professor Chirag Gyara, Ms. Niyati Dave. I welcome all the students and all the students fraternity and academicians who have joined over here in this conclave. Basically, the Department of Public Policy and Governance, it conducts various webinars which brings the great knowledge among the students, and specifically we have started with this International Management Conclave series, which is aiming at creating a problem and creating a platform which will solve the problem, which will give an idea to solve the problem, to enlighten everyone regarding the changes in the current world in the COVID times. This conclave brings together all the achievements, numerous academicians, scholars, students, industry leaders from different parts of the globe, and we are trying to put together all the ideas of the different fraternities and the industry professionals across the globe in different conclaves that we are about to organize, which we have started with the International Finance Conclave. Again, we are having to have International Marketing Conclave, International HR Conclave, International Management Conclave, and then International Public Policy Conclave. So the series, and this is the first in this series, and in this series we have a very well-known professionals over here. So I welcome you all on behalf of the Department of Public Policy and Governance, B.K. School of Professional and Management Studies, for having you over here and spending the valuable time and guiding our students and across the nation, whosoever has joined. I welcome all the participants across the globe who have joined over here, and wish you all a happy learning. Have a nice day. Thank you. Over to you, Purva.
Thank you so much, ma'am, for your wonderful words. On the occasion of the first event of the Management Conclave, the Department of Public Policy and Governance would like to release their first ever issue of the Department of Public Policy and Governance newsletter, which is a glimpse of the journey shared by the students and the faculty members of the department. Now I request our newsletter team to release the first issue. Thank you.
must
On behalf,
congratulate the students team who has prepared this newsletter in a very short span of time, and I must congratulate all the students. Just in 4 months, you have done a lot of activities and wonders. So congratulations.
thank you so much, newsletter team. And on behalf of the students of Dppg, I also extend my thanks to Neelam ma'am and Darshini ma'am for being our constant support. Now, let us begin with our event. And as our first guest, I take privilege in welcoming Dr. M. Subramaniam, an alumni of IIM Ahmedabad who has got 23 years of experience at industry, teaching, research, and consulting. He is presently the head of the management programs at RL Institute of Management Studies, Madurai, Tamil Nadu. He has worked for companies like Vardhman Threads, Big Shop Group of Companies, Kumudam Publications, and Janalakshmi Financial Services in various positions. He is SEBI certified financial educator, SEBI certified research analyst. He has served as teaching faculties in various premier business schools and institutions like Amity University, Noida campus, Institute for Technology and Management, Thiagarajar School of Management, and IILM New Delhi. Sir has published and presented more than 40 papers in various national and international conferences and also won many Best Paper awards. As a researcher, he has published and presented management case studies and has also won Best Case Study awards. He is an accredited trainer consultant for NTPC, STVN, Power Grid Corporation, NISG. He trains the top management executives on the enterprise risk management, leadership development, finance for non-finance executives, and financial engineering topics. He is a certified international trainer on leadership skills for mid-level managers. Sir is a regular trainee and faculty at Institute of Company Secretaries of India and Institute of Chartered Accountants of India on soft skills, capital markets, and strategic management. He is a regular trainee and faculty at LICO on finance for hospital administrators and international management development program. He is an active business quiz master and conducts various business quizzes pan-India. His qualifications include his pursuing postdoctoral fellowship at finance at Lincoln University College, Malaysia. He has a PhD in finance, FTPM from IIM Ahmedabad, MPhil, MBA, MFC, MA, PGDMM, PGDRM, PGDPRM, BGL, and BCom. Sir, it's an honor having you as our panelist. Over to you and a very warm welcome to you. Thank you.
Thank you very much. Am I audible to you now?
Yes, sir, you are.
Right. Thanks a lot. Very good morning to the ambitious members of panel today and the active listeners of today. And thank you, Dr. Neelam, and thank you, Gujarat University, for the opportunity provided. I'm here to share my experience on the recent trend in fintech in India, as well as I want to share my thoughts on blockchain fundamentals. I want to just create some interest, kindle some interest towards the student learners towards fintech and blockchain fundamentals. So the session will be has been prepared towards the student learners who can pick up something in fintech, as well as I'm going to kindle some interest in blockchain. Even I will be teaching you and training you on a couple of things in blockchain today. Right, let us look into that. Let me share my screen to you. We'll start the presentation as we have short time. I don't want to waste the time on any other thing. I trust my screen should be visible to you now. Is it visible?
Yes, sir.
Thank you.
Yes, sir.
Right. Thank you. So I have divided my session for you in two ways. One is fintech in India. I'll be giving a glimpse about how it is. and let us learn some blockchain fundamentals. So in another 15-20 minutes, we'll be learning all these things now, right? Uh, let us move on with the presentation. World of finance before fintech. Just I won't take a stock before fintech, financial technology, how the world of finance was there. So how this fintech evolved? It is a combination of finance with technology. Already we have umpteen amount of combination like this. Classical example in banking is using of the core banking system, and banking itself is a fintech, right? So let us understand how it is going to be. So the pros of pre-fintech era and cons of post-fintech era. I'm going to take you into a different platform, a different style. So what about the pros, the prospects pre-fintech era, and the cons, constraints post-fintech era, right? So you'll be able to see the pros of pre-fintech era was before the fintech, the banking was so good. The bankers and the client were having personal relationship, personal touch was there. But the biggest con here, lost the personal touch in banking. I think people who are using either by mobile banking or online banking very, very rarely visit the branch. Either the branch manager or the branch staff does not know the customer client, and the client does not know who is the branch head and what is happening in the branch. So which is very key in finance domain, which is being missing today. The number two, the scale and number of financial frauds were less comparatively. That is what my understanding is. I was going through the number of frauds and financial misrepresentations before this fintech era or the tech savvy era. That was less when compared. But today, what has happened? Multiple fold and rise in financial frauds we're able to see. Every day in the morning, we're able to see phishing of accounts, cards have been lost, they're able to banking into your account, do not use this UPI, lot of challenges, data lost. We're able to listen to a lot of stories. Limited financial products were there earlier, and services was good and it was easily understandable by the people. But because of fintech and globalized finance, what is happening today? We have complex financial products and difficulty in comprehending those products. If you go and ask your father or grandfather, they may not understand the today's complex financial products, right? If you talk about derivatives, if you talk about carbon trading, many of the previous generation or even this generation may not understand what I'm talking about. So they may have a vague understanding, but that is where the cut is. So the pros of pre-fintech era and cons of the post-fintech era, that is what I thought to make a comparison, right? How did this fintech or financial revolution happened in India? Or let us take a stock across the world, then we'll go what happened in India. So here I've given a very short glimpse of the paper. 1950s, the fintech started by Diners Club introducing the card, and today we are able to see there is a disruption in payment market. The Indian digital finance ecosystem is completely disrupted because of innovation. So you can see 1960 we got the first ATM, and 1970s NASDAQ was introduced, the world's first online exchange. National Association for Securities Dealers Automated Quotation, the first online electronic trading was introduced in US. And in 1980s we launched the e-trade, electronic trade, online trade for stocks, and telebanking was introduced. You can see step by step what happened, right? So in 2000 we started using PayPal. We all know about Elon Musk, the man behind the PayPal. We started using PayPal, the first online payment platform. After that, we can see what kind of disruption happened in the market today, right? Alibaba came, they entirely changed the game of the online market, and today we are able to see almost 43% of Indians are influenced with the help of financial revolution. So how did this fintech came? One side we have the finance, the other side we have the technology. The combination of these two is fintech. So one side we have bank, the payment companies, NBFCs, the non-banking finance companies, security brokers, of finance. So one side we have the suppliers, the other side we have technology, the hardware projects providers, the software providers, cloud. We are not in the form of storing everything and losing. Today we all know about the platform providers are there. Today we have umpteen platforms. Not only we are depending on one platform, we have more number of platforms. When we integrate these together, when we are able to take a blend and integration of finance and technology, there comes the concept of fintech. How does the fintech ecosystem is there? Let us have a look into, even India, we can take a look. We have fintech startups are there. Classical example, I can give umpteen amount of companies. We have payment companies like Paytm, PhonePe, right? They are fintech startups. Other side, the government who is regulating with RBI, all these fintech companies are being regulated. Other side, we have traditional financial institutions like banks. Let us take banks. So when Paytm like company, PhonePe like company comes, banks are there. So Paytm like company is a fintech company. Government is the regulator. On the other side, we have the bank, traditional banks. They are now integrating, or they are now joining hands with the fintech companies to make payment solutions. On the other side, the financial customers like you and me, the companies you and me, everybody is a customer. On the other side, we have technology developers, right? So because of an offshoot of the fintech like platform, the technology is being evolved like anything. Big data analytics, business analytics, fraud analytics, accounting analytics, cloud computing. So umpteen amount of technology. So all these put together, we call it as the financial ecosystem in India. So Paytm is a classical example of fintech startup. Government, we know the role played by the government through RBI. Traditional financial institutions are there like banks. Customers like you and me are there. Technology company, we know that umpteen companies are there providing technology for the fintech platform. So this holistic ecosystem is said to be the fintech environment in India. So let us see what segments we have in India. For example, we have digital payments are there. When I say digital fintech, don't restrict yourself only with the digital payments, because we are restricting ourselves only with digital payments. So digital payment is one part of it. The next one is alternative lending we are taking. For example, today we are able to see something called crowdfunding, a source of finance for new technology companies. Crowdfunding, without even seeing the business, without even looking personally, crowdfunding platform, online technologically driven platform is being happening. That is a classical example of alternative lending. Insurtech, insurance has gone online today. Let it be claim settlement, let it be buying a policy, let it be raising a query, let it be interacting with them. Everything is online today. Investment tech, we know that stock markets, mutual funds, gold, any kind of investment if you want today, investment tech is there available. RegTech, RegTech is about a regulatory technology for fintech companies, technology companies, what government has made. And finally, the bank tech, banking technology. So all these put together, we call it as the fintech segments. I do not know how many of us are aware about these kind of segments are there. If you want to take up some career in fintech, these are all the available segments. You can pick up the career if you have either the strong finance knowledge with the technology background or strong technology background with finance knowledge. Definitely you can pick up a career. So both will be complement. Technology with finance or finance with technology, both will be complementing for picking up a career, making a career. Indian fintech scenario, how it looks like. I thought to throw some lights. Instead of reading everything, I'll give you where we are. India, still I find we are in the nascent stage. Just 3-4 years back, we started the digital platform after the demonetization in 2016. In 3-4 years, we're able to grow this much. What we have to do now is, number one, we have to streamline the regulatory things of the fintech in India. Number two, we should encourage more professional players to be in the fintech platform. Number three, we need to grow technology with foolproof system. Even though we all are aware that there cannot be a foolproof system, there will be breakers of the foolproof system. We need to create such a kind of ecosystem and foolproof system to ensure the confidence of the users, you and me, right? When these things are there, Indian fintech will grow like anything. Already we are in the top 3-4 fintech players in the world, India ranks among top 3. We are not behind any other country. We are in the top 3 in fintech segment. Digital payments, we are number 2. Fintech, we are number 3. So already we are at par, but still further we want to strengthen our core strength in fintech and digital payment system with the help of technology through security. The cyber security is very important. India is now working towards that. Whatever you do, whenever it is technology enabled, hacking, cybercrime possibilities are there, we have to see in what we will be able to protect from that. So what kind of things ahead of it, then I will go to the blockchain fundamentals. See, we have to collaborate, as I said, we have to collaborate effectively with other fintech companies and financial institutions. Instead of competition, we all know that strategically today everybody is thinking about co-optation. The fintech companies, traditional finance companies and banking companies should co-opt and they have to grow. That is one way ahead we can do. Number 2, fast fail approach should be there in this fintech segment. We have to be faster, even let us fail, nothing wrong in it. From failures we will learn and we will be able to redo something better. So fast fail approach is much more required in the technology environment. In fintech also we need a fast fail approach, nothing wrong in it. Failure may be the first step to success. We should not be having any shy away to fail. We should fail and we should be able to get up fast and we should be able to provide solution. Going forward, consolidation is a key. We have seen that in a banking segment, right? Typically, there should be a lot of consolidation happening in technology, finance, and fintech and banks. There is going to be huge amount of consolidation going to happen. I'm sure, mark my words, in another 3 to 5 years, we'll be able to see umpteen amount of consolidation in terms of banking, financial, and technology startup companies going to consolidate like anything. So this is, I thought, to throw some lights on fintech. Now let me move towards blockchain. So what we are going to learn about the blockchain technology. So blockchain, moment I say the blockchain, how it works, let me explain it to you. For example, let us take the screen, how blockchain helps and how blockchain works. A wants to send money to B. That is the first step. Now, number 2, the transaction is represented online as a block. So if I want to send money to Mr. B, my transaction will be represented as a block. Number 3, if you move towards, the block is broadcasted at every party in the network. There is a network of payment network is there, payment ecosystem is there. Everybody will know about that. When I say it is again coded, the network approves the transaction. They say approves the transaction, everything is coded. Though everybody knows it is coded, nobody can decode it. If I send it to you, only you will be able to understand it, you will be able to get alert message. The coding, decoding happens between only you and me. It is not about knowing about others. But others will know that is a transaction, but it is not known that it is between you and me. The next one is, similarly, blocks are being created and the transaction is complete. No transaction is duplicated, every transaction is safe and virgin. That is the power of the blockchain technology. So here is a classical example how it works. One party requests the transaction, requested will go to the other one in a funneled way, the peer-to-peer network, P2P, peer-to-peer network, and the individual nodes will receive the notification and the blocks are being created, the chains are being created. I'll explain this with what kind of properties we have in DLT. Moment I call something as blockchain, there comes the role of DLT, distributed ledger technology. What kind of distribution? It is about distributing the network. For example, a blockchain is a programmable language. We all know about that. So what kind of programmable language we are going to use it? It is going to be distributed among the network participants, and every participant will be having a copy of ledger with complete transparency, by the same way complete security, because it is being coded. Decoding we have to do, coding, because the records in blockchain are basically immutable. When I say immutable, any validated records are irreversible, cannot be changed. Even if you add a comma, the codes will change and you will not be able to process. It is time stamped. Everything is time stamped. So it is very difficult to break the code and copy it. That is why cryptocurrencies today, cryptocurrency are not officially approved in India today, like bitcoins. Cryptocurrency use blockchain technology. That is why it is foolproof. But people still have fear because government has not approved and cleared that. But still they have fear. It is immutable. It is time stamped, secured. In many ways, blockchain technology is saving the cryptocurrency like investment. The same blockchain is used by banks, same blockchain is used by stock market investment brokers, everybody is using it. So where these blockchain technology are being used as a digital currency, yes, it is being used for e-commerce, global payments, remittances, peer-to-peer lending, microfinance, everywhere it is being used. For example, bitcoins is a part of digital currency. Record keeping, blockchain is used in healthcare industry to voting. Norway is the first country which used blockchain for voting. They tested, not completely gone for it, tested Norway. Securities market, as I said, starting from equity to derivative, everything is connected through blockchain today. And smart contracts, any contract today you call in business, we are moving towards blockchain technology and is being used. Might be in another 2 to 3 years time, everything will be driven by blockchain. As on date, it is one of the foolproof, secured way of making financial transactions, business transactions. So I strongly recommend the students to learn blockchain technology if you are aspiring to take up a career which will give you boost for the next 5 to 10 years time. So I'll take you through an example and I'll help you how to understand blockchain. So blockchain is constantly growing ledger that keeps permanent record of all the transactions that have taken place in a secure, chronological, immutable way. I will explain you how to use the hash function, right? Hash function, I'll tell you how to use it. I'm taking you through this particular link. I open this link and I'll help you how hash function is being created. I'll stop the screen. I will show you that screen. Give me a minute. It is like a demo to you because hashes are being used in blockchain a lot. I'll explain you with the block function, hash function, how it is being used effectively. Is my screen visible to you?
Yes.
Right. So here we can see, look at the hash function. Hash function, there is a default hash function for empty data. There is no data there. You can see the hash. Hash E3B0C44. There is a big hash function is there. You can see the data is empty. Just see what I'm doing. Are you able to see the change in the block hash now? Look at that. When it was empty, it is E3B0, right? When it is empty, I'm adding my name, one letter there. Yes, you look at the hash. Are you able to see the change in the code? I'm adding one more word. Again, there is another change. One more word, another change. One more word, another change. So what is happening? This particular blocks hashes are being created by changing even a small change in the data. So data is highly secured. Even if somebody wants to move, there is small distraction, data will have a change and reflection of hash will be there. When hash functions are not matched, you will not be able to build a block and it will be a miserable failure. This is a classical example. I would like to explain one more function with this, how to create blocks. So with this, how I am making blocks. I will now help you how to make the blocks. I'll again make a demo to you. Look at here. This is block number 1. Is my screen visible to you now?
Yes, we can see.
Yes, sir,
Right.
it's visible.
Yeah. This is block number 1, and nouns is being created. Nouns I cannot explain you each and everything now. I'm just showing a demo to you because I thought to create a curiosity to the learner students today how it is being created. Block is there. I'm creating a nouns there. For example, if I make, you can see the color of the block is being changed. The hash also changed. I will save this in the noun 7208. Similarly, what I will do, I am mining it now. I have created it. I am mining it now. See, the next nouns comes. The previous nouns is 72608. Now I have a different noun, different hash function. You can look into now. If I'm adding something else, if you keep on mining it, you can see there will be a change in noun, there will be a change in hash also. That is the power of blockchain. So blockchain is highly secure, immutable, time stamped. If I'm doing the change by 1050, the time is being stamped there. You can see the different nouns, so you will be able to see different hash function there. So it is a clear indication that this blockchain is going to rule the world definitely for some time now. There is no change, there is no dearth of understanding for me. Definitely it is going to change the entire world and making a blockchain connected world for all the financial transactions on business transactions. So I thought to share these thoughts with you about fintech and blockchain to show some demo to you. Thank you for the opportunity. I'll be waiting for questions, or at the end of the session also we can take the questions. Thank you everyone. Thank you, Dr. Neelam.
Thank you so much, Subramaniam sir, for conducting a very informative session for our students. And yes, we will be taking the questions at the end of the session.
Thank you.
Now, I would like to invite our second guest of the panel, Professor Shantanu Mehta. Professor Mehta has 22 years industry experience and 16 years teaching experience at postgraduate courses in business management. He has worked with GSFC, UTI, NSE stockbroker, and a merchant banker. He has experience in the area of accounts, project finance, mutual funds, money market, stockbroking, IPO and private placement of equity and venture capital. He was the visiting faculty at IIM Nagpur, MICA Ahmedabad, IIM Ahmedabad, SP Jain Institute of Management and Research, School of Petroleum PDPU Gandhinagar. Sir has completed many consultancy assignments for banks and stockbrokers and conducted training programs for Intes Pharma, Indian Air Force, ONGC, Nirma Limited, Adani Port, Johnson, Hitachi, and many more. Sir is a member of Investors Grievances Resolution Panel of National Stock Exchange at the instance of SEBI. His area of interest is accounting disclosures, investors' education, and capital market. Sir is here to speak on the theme Financial Management Relook at Use of Tools and Techniques in the Change Scenarios. Sir, I extend a very warm welcome to you, and the platform is all yours. Thank you. So kindly unmute yourself.
Thank you, Purva, for introduction. Thank you, Dr. Neelam, for inviting me for this nice participants, the youngsters, whom I love always to interact and share my experience. So thank you, one and all. At outset, let me tell you that as per the theme of this international conclave, international finance conclave, financial resilience and pandemic. We all know the pandemic has changed all rules of the games, especially in the all functional area of the management. I, being a small student of the finance and accounting field, I restrict myself to what is expected now what the students you are expected to face the challenges away from what you are learning in the classroom, and that's what my whole focus will be. So let me start with the presentation. Please allow me to share my PPT. Is it allowed to me now?
Sir, on the right corner, there is a tab of present now. So you can access that and present your PPT. Bottom right corner, sir.
Just a minute. Yes.
Yes.
Thank you. Can you see? Can you see my PPT?
Not yet, sir. Not yet.
I'm trying to share entire screen. Is it okay now?
No. Yes, sir.
Okay. Fine. Okay. So the some small topic I've chosen within 20 minutes. I justify what is my thoughts and views on the present theme of the conclave. Financial management. Relook at the use of tools and techniques in the change scenario. We all know what is change scenario. So as beginning, let me apologize in advance to all my learned research scholars, faculty community. My views here expressed are on my own, and if you do not agree, discard them easily. I am sorry if they are heard. My presentation is based on my continuous interaction with the business and industry, and more with my students who are at the top positions and still in touch with me. The presentation aims to apprise the students for facing challenges in the practice in the today's situations. We have learned a lot in our MBA course and before that also. So how our learning required to be relooked and reorient ourselves for whatever you learn. Of course, in the financial management, nothing beyond that. So that is my focus. So my content is some interesting happenings in the last years. Finance function, what was till 80s when I was just beginner in the learning of the finance and accounts, till last year and now question mark. Conventional tools and techniques learned in the financial management and what should the different approach and practice now. Is our academic system dynamic enough to incorporate this actual practice? Let's see. And last is the question mark, question answer session. So some interesting happening in the last year. We all know economic downturn in most of the countries. Entire business confidence is completely shaken. Certain businesses adversely affected very heavily. Aviation, hotel, tourism, automobile, to some extent also. Automobile, not but fully, but yes, to some extent. Government expenditure increased without corresponding increase in the revenue. Pressure on banking system because the relief announced by the government and the relief to the borrowers, and stock market crash in the initial March, April, May. So this was the scenario we see last year in 20. But yet there are different things happen in the last year. Stock markets bounce back and give more than 50% return in the year. Some of the scripts have given 100% return. Sizable increase in the demat account opening. This is unbelievable thing happen that many people switch over to have direct investments in the capital market. Some industries show very good growth. Obviously, pharma, FMCG, IT software, online platforms meeting academics through which we are talking now. All these things were not there 1.5 years back. Now this has suddenly come into the more variety of the product in the market. Computer hardware, different kind of devices to facilitate the interaction and learning and examination. So many things have happened. Companies have come out with the online learning, almost replacing the school education. Many companies floated IPOs and most of them give very good return on listings during this pandemic situation, April to September, October. Companies mobilize equity to repay the debt and increase the valuation of such companies. Absolutely unconventional financial management theory. We'll talk about that little late. And such more happenings can be listed, but we are all reading every day. So despite all the despair situation, expected thing happens in last 1 year. That's I wanted to list here. So let's try to learn that yes, everything is not gone, but what we require to reorient ourselves. So finance function till our 80s when I was student, just beginning of the student. The definition given by Professor S.C. Kuchar of Ahmedabad in his finance book, that it is the resource mobilization and efficient use of the funds. That's it. This was the finance management in 80s. Thereafter, the things changes and the definition of finance management changed, that its role as a shareholders value creations as a finance management. The shift from the functional management to the part of the strategic management, it shifted. Not only the resource mobilization, but they should first decide where to invest money. And now in future, maybe different goal may come 2 years down the line, we don't know. And the all tools and techniques which you are learning may be substantially redesigned to be used to solve the problems. This is what I feel. Let's see what it comes. I am unable to foresee what will happen. But yes, it is certain that all tools and techniques are designed. So let's work out what we have learned and how far we are useful now. So decision, the finance management to create shareholders value are mainly investment decision, financing decision, and dividend decision. We are learning so nicely in our curriculum by the good professors. So tools for the investment decision, we know capital budgeting, payback, NPV, IRR. We master the formula and arithmetic and feel that financial management is a scoring subject. Is it enough? No, we require different approach in the practice. Is the forecasting of the cash flow reliable? What assumption have gone to forecast the cash flow? We never think as a student. We are very good given the problem we solve in the examination. But anybody asks, whether I say sales less cost, is it the correct? Given to the situation, industry, size of the company, so on and so forth. What should be the discounting rate? Higher the discounting rate, dismal picture. Lower the discounting rate, rosy picture. So what should be the discounting rate? We don't know. Even there is no consensus among the all CFOs in the world over. 5 years back, HBR review published this paper. There is no consensus. Is the WSSC still good benchmark? Because WSSC itself becomes so dynamic in terms of, I'll give one example. HDFC and SBI mobilize resources, financial resources abroad at 2% to cater the needs of the deferment of the EMI. So what is now the subsequent WSSC? Can anybody think? Anything is so dynamic that you cannot have a rigid rule to benchmark something. What should be the period of cash flow? Again, 3 years, 4 years, 5 years. Can you project for 10 years today? Who has projected in 2015? What is my 7 years project? Where he is now? What is the figures? All figures converted into brackets. So this is the dynamics in the business. We are yet to learn in the classroom, and our academics is yet to prepare for to incorporate. See, preparing NPV is a function of Excel sheet. We need not break our heads in solving those arithmetics, but the use of tools and techniques. So this is the different approach we'll talk about. I'm just trying to point out. And this is till yesterday. So what will happen tomorrow? You are complete change in the rules. Financing decision. The tools we are learning. NOPED, Modigliani and Miller model. firm value or equity value, whether you should start with V0 or E0, VE, value equity. Can we value debt in India? Question mark. We cannot as of now because we don't have vibrant debt market. Still we learn those things. Very good models. But are any of the assumptions behind this model can solve today's problem? There is no tax in the economy. You can switch over from debt to equity, equity to debt as and when you want. The lender is not sensitive to your own debt equity ratio. See, you read those assumptions. Yes, it's good to learn in the textbooks and MBA curriculum and get marks. Does it work in the practice? You have to find out when you go to the practice. Debt is cheaper to equity, we all learn. Why? Because it's a fixed guaranteed return of return and repayment. You give a loan, so there is a security more or less, and you know 7% I will be getting. It is further cheaper if it is because of the tax shield. We know interest is a tax deductible, so we do KD minus 1 minus T. KD is equal to 1 minus T. That's what we work. But what many corporate have done recently, I will not name, you know, they came out with the rights issue and announced that we will repay all our debt within 1 year, 1.5 years, and see the value of that share, what has happened in the market. And investors accepted this contention. And thereafter, many IPOs come. Many of the objective of the IPO was the repayment of the loan and see what is the valuation. So is it the fundamental privilege changed? We have to find out the answer. We don't know. At least I don't know. Dividend decision. Trainer model, Walter model, so many things we learn nicely. Tools, models suggest that the crux of all these models is if the proposed ROI is more than the cost of equity, don't pay dividend, and if it is otherwise, pay 100% dividend. Simple thing to understand. You spend the money if you do not have investment opportunity. Can this work now? Profit is earned daily and not when we prepare the P&L. This is the reality every MBA should learn in the practice. You go and ask any balance sheet, oh, you have this much reserve. A reserve is already invested in some asset. Reserve is not accumulated profit. It's not source of finance. It's a myth we take as a source of finance in the project financing. It's already, and profit is earned. It is realized in the cash when receivable gives you money. Your receivables pay, debtors pay you money, it is realized. And it is immediately invested in the working capital. You repay your creditors, you buy new raw material, you do, sometimes you have lot of surplus, you may commit to some fixed assets as a margin, not beyond that. So this is the reality. We should know and this will be more complicated in the days to come. Further, in order to manage the situation like today, many companies never thought they earn money and they spend, they invested. Now those who do not have cash money with them could not pay the salary, could not pay their creditors, and they are in the deep trouble only because of now onwards. Every company has to keep liquidity invested as a cash equivalent without looking how much return it gives. It may be negligible, but unless you have cash equivalent ready with you to face any such challenges, and it's going to be there for another 2-3 years. Believe me, yes, we'll come out of this situation, but we should be extra cautious in the days to come, and we should be always ready for anything to happen, because this has never happened in last 100-200 years that such a things can happen all over the globe. Earlier pandemics were there, but limited to certain countries only for certain reasons. Today we are integrated. So this aspect is not there in any model, that when you decide on the dividend, have you parked cash equivalent to face any eventuality. It must be part of your learning before you take a decision, dividend decision. Let's see, some people, some scholars come out with some solution in the days to come. Another thing which is not yet part of the financial management is the indirect cost management.
Sir, sorry to interrupt. The slides are not scrolling.
Is it so?
Yes.
Where, from which side it is not there? This was there.
So right now we are on the first slide itself.
That's it.
Yes. Sorry to interrupt.
No problem. You should have told me anyway. Let me. Is it now?
Yes, yes,
Yes,
yes.
for a
Then
change.
when I make the slideshow, it is not showing. Okay, should I repeat?
No,
This
no,
is,
that's fine. Just I'm just bringing to your.
I will just look at this first. This was need to be understood very well. Are we doing the right cash flow assumption? Do we have consistent on discounting rate? Does the assumption can solve the problem? Is it valid in the practical scenario? Dividend decisions, as I said, profit is on daily and invested in the working capital immediately. And we should keep some cash equivalent always available to face any challenges. Unforeseen, not business challenges, but unforeseen. And yes, this is how was here. Financial management indirect cost is not yet that given weightage in the financial management, but that's going to be cost accounting subject is there, but it covers ascertainment of cost and allocation of indirect costs and not its management. Indirect cost management should be part of the financial management because those who are committed to the higher overhead are in great difficulty. If the volume drops, you are suddenly in problem. There are certain business I know that overhead cost is inherently high, like hotel business. But in the normal business, you should be extra cautious. So the commitment to the overhead and sunk cost should be one of the finance decision for survival and sustaining business. That's what I can foresee after this pandemic in the days to come. Other concepts and theories, I'll just quickly go through it. Investment theories, model developed in 60s. Is it hardly relevant today? Of the, I will not name those things. Valuation model like dividend or growth model, I don't know. Can you assume that this will be the dividend and it will grow at 10% now for individual companies to learn something? Because dividend decision itself is going to undergo the change. The relative valuation model is not given due weightage in the syllabus. While the whole world is going towards it, you open the SEBI guidelines, they are also telling you for IPO, you have to make the comparative PE industry and then decide justify your price for IPO. Nowhere the direct valuation is because it is suffering from three biases: period of cash flow, assumption behind the cash flow, and discounting rate. So relative valuation will have a lot of weightage to come into this. We know the beta calculation very well, but do we know the two things of the characteristics of the beta before using it? It's a function of the time horizon. If I take 10 years beta, beta is 1. If I take 10 months beta is 2. So using beta, all students should be very, very clear in the real practice. They should not take, as I said, they are masters in formula, but do they know? And it should be industry specific. We take simply the BACD, beta or something. We must work hard to take out. If you want to go move towards the better understanding of the problem, decision making is a different process. And when we use the free cash flow, how to project the terminal value of the assets of a firm? Can you estimate as a going concern? Question mark. We are learning in a very good books that you should estimate as a going concern. I give you example, 2-3 companies in a nearby and take up the balance sheet with the experts, work out the terminal value. It's a big challenge. It's not easy. You are given some amount, so you become not valuer, but arithmetic experts. So this is the challenge you are going to face when you go to the industry next year. And after doing all this valuation, is it worth? Because valuation at the end of the day is a perception and price is reality. It's not me saying. Supreme Court has said in 2-3 judgment, one of them was Vedanta, Stro Products, and recently 2-3 things, that we can vouch the process of valuation. We cannot say valuation is right or wrong. It is the price which other party is ready to pay should be accepted when a public litigation was filed against the dealing of certain takeover. So this is the things which we must know, especially in the change scenario. We are learning very good theories. So is our academic system, I may be pardoned by all academicians. No, no hopes in near future to incorporate all these things with a different approach. Even long term, let's pray that something comes in the reality to the classrooms. Above points are true before pandemic, but now they require serious attention. So what to do? Big opportunity, my dear friends. Industry is waiting for good professionals. Acute demand, dearth of good people who can work, and they need not be academically scholars. Nobody will ask you 3 years down the line what was your CGPA. They will ask what you have done in last 3 years. Tell your credentials, tell your accomplishments in last 3 years. This will be asked, and nobody will ask you what was your CGPA or have you got the gold medal. Yes, it's there up to certain level. So prepare for this. Open up your mind, read something different. Do not be slaves of the tools and techniques which you are learning, but develop wisdom of using them properly for given situation. And this will single out you from the crowds of MBA and you will be at the top of the ladder. Thank you very much. Best of luck for your career. Thank you.
Thank you so much, Mr. Mehta. It was wonderful listening to you, and I feel very privileged listening to you. Now it's time to welcome our third panelist, Mr. Piyush, who is the Senior Vice President of Gujarat International Finance Tech City. Sir, we welcome you, and the stage and the platform is all yours. Thank you.
Yes, thank you very much. Am I audible to everybody?
Yes, sir.
Yes, sir, you are audible.
Yeah, so to start with, the good morning to everybody and my predecessors, all speakers who are very well learned people. So whatever I am going to speak is the extempo speech of what is my experience of last 2 years, in fact, 1.5 years, which is more relevant now in this present scenario. As Mr. Subramaniam and Mr. Mehta has said, the world is changing and we have to change ourselves and change the techniques. So that is what the rightly mentioned by them. The one is the fintech, which is a reality, going to be a next reality. And as Mr. Mehta said, the old techniques of dividend payment and the ROI and all this is not much relevant during this scenario. So to start with, I know there are issues and challenges in corporate finance, which is not a new thing. In fact, we start with every year there is a challenge for the corporate finance. And last few years, it starts with the demonetization, then the RERA, then the GST and everything. So there are constant challenges. So the pandemic is one of the challenges, and it's not that we are facing this all challenges first time. So going for the issues and challenges, I wanted to just present what is the positive out of this. That is what I look for, that what positives has been happened during this 1 year. Yeah, we are all facing the problem. Some industries are facing the problems of cash flow, but on the same time, some industries are flourishing, as Mr. Mehta said, like pharma, IT, ITs, and you see the stock market, which is a 50,000 in the pandemic year, which is a history for the Indian stock market. So there are ways and means how you can create a value from the existing situations. So if I talk as my company, let's the gift. We have a one positive, very positive thing is, as Mr. Subramaniam says, that fintech. We in our company have one area which is the International Financial Services Center, which is a license given to our company, is the only license given, and whoever is performing from this is have to deal with the foreign currency only. So this is what we are going to do is onshoring the offshore things, which we were not been able to do from the India up till now. So let's say in the banking, if I wanted to take an ECB or something, we have to go approach any foreign banks or any foreign branch of the Indian banks, and we have to take the money from them. But because of this IFSC status in the gift, what is happening that any bank which is opening a branch here is considered to be a foreign branch. And same way the insurance company, that they can do the reinsurance business from here. Then the stock market, we have both the exchanges, international exchanges, BSE and NSE, who deals with the derivatives transactions, which we used to do from the Dubai or Singapore. So these are all the positive things which is coming. And if we go as a corporate, a specific kind of a thing, as really Mr. Mehta has also said that Now everybody is moving towards reducing the debt. We know in the theory that if your business is good, then more debt is always good, which is what we learned up till now. But now the scenario is this, that people are start repaying the debt and going for the equity or right issues, which we have seen in the last 6 months. There are a lot of issues of QIPs of the banks, then the right issues by the companies, IPOs from the new companies, which formerly normally they were going to the bank for the debt. But this has changed the things very much on a positive side. So people are smart enough, and the CFOs and everybody's is what now they are doing, that we have to how we can strengthen our balance sheet and then spend the money and allocate the resource to a valuable things. Let's say in our company, what we have done, there are some of the fixed costs. We have tried to reduce it, and we have outsourced all these things. The way we can reduce the cost. So these are the ways and means from which we can strengthen our balance sheet. And the most positive part, if I have to say, that we have seen that the help from all the industries, let's say banking. Let's say I give you a very practical example, that we have taken a loan, we were having an escrow account, so there is no checkbook available to us. So whatever payment which we have to make, we have to write a letter to the bank and we have to send, and then the bank will make the payment to all our parties. Now, because of this pandemic, everybody was work from home. So there was no signatories available to sign the letter. So we have requested the bankers that please allow the soft copy, and then we can get it signed once we will go to the office after 1 month or 2 months, which they have readily agreed. So all payment has been made on trust. So these are the things which normally was not happening before. Even if there is 2 signatories required, if there is a 1 signature is there on the letter or a check, bank were not accepting my letter. They said no, dono ka signature chahiye, ye chahiye, wo chahiye. The same set of people of PSU banks or a private bank have changed the totally. So these are the positive things which has been happened. Though we are apart, we came closer. Right now, see, everybody is at their home or they're at offices, but we are readily available to each and everybody. So there are positive things of not being together, but together. So that is what is happening because of the pandemic. The teamwork in the company everywhere has been a solid now. Before we were knowing that in corporate and everywhere there is all politics of this and that. But as on today, if I see in my company or any other company which my friends are working, they said that there is a lot of teamwork. If suppose something is happened to me, there are full team will come to help me, even if we are not in the office. So if you see the positive side of the pandemic, because this pandemic is common for everybody. It is not for richer who can easily stay at their home and poor is affected. Everybody is affected. And then everybody has realized also that being together is the days of the things, and then we have to work together. So I find that the teamwork has gone very much. The family bonding, that is the other thing which has been gone very, very well. If I give the example of my son, Mr. Mehta was in SP Jain. My son has studied in the SP Jain only. So he was there in Bombay from last 7-8 years. 4 years he was in NIT Surat, then 2 years into the BPCL, and then 2 years into the SP Jain. So 8 years he was not with us, and now from last March he's with us working from home. So that kind of a bonding is also a scale. Yeah, the only problem which we face as a corporate is the availability of the labor, which was there. But slowly that is also now coming up. And there is alternative ways and means which we are using for the value creation. And the other thing that we learned all these things, which probably I was not learned before it, how to use this laptop, go for the virtual meeting. So these are the positive things which we learned a lot out of this. So I find that this digitalization as in a way is going to reduce the cost. My administrative cost and everything is reduced. So there are ways and means in which all the corporate has managed themselves. And I find that whatever corporate is there, they've helped their employees a lot. In our case also, if somebody has got COVID in their family, they are allowed to stay home. Their salary has not been cut. Yes, they've given timely promotions also in this kind of a year also. So many things. If I think of my any corporate in the Ahmedabad also, they all have allowed them to work from home. Their salary has not been cut. Yeah, the affected people are at the lower level, meaning this small businesses and all these things. But if you see that corporate level, I didn't find that many of the people, they say that, okay, my job is gone and all these things. So as being a corporate, all corporates, which very happy to say that all corporates has done very well for their employees also. So these are the good things which we find. The relations with the bankers, with the creditors, with the receivables, all are very good. See, because everybody knows that this is a genuine problem to everybody. So somehow everybody has managed themselves. We have not paid to our creditors, but they have never stopped supplying to us. Same way, we have not forced my receivables that, okay, no, you have today, otherwise this and that, or we'll go to the court and all these things. So in all, the RBI has also helped everybody. The government is also helping all of us. So if you see on the positive side of this, then I find that during the last 1.5 years, we have grown much. In fact, we are more sensible than what we before it, because of this kind of a things which has happened, which we have never thought that it will happen, and we wish that this should not continue. Yeah, there are some bad things happens that people have lost their jobs, some has lost their family members, but this is part and parcel of the life. But as a corporate, I see that my relations with outsider as well as the family member as well as the colleague and with the management has strengthened because of this pandemic situation, where all are coming together. If I go to anybody, even if I don't know, even if I go to anybody, everybody is going to help each and other. So that is the best part is happened because of this pandemic. Otherwise, as a corporate, we know issues and challenges are every day is there, and we know how to deal with it. And as Mr. Mehta said, that the new student, only theory will not work now. ROI percentage or a dividend policy, this will not work. How practical you are in clearing your ideas or doing your job in such kind of situation will get you the good things. And as he rightly said, that as a corporate, we also want such kind of a professionals who are ready to work anything, even if it is not their core area of working. In this situation, they should start working with other departments or with some HR functions. Even if they have to do, they have to do. If they have to deal with the receivables, creditors, or with the other departments, then everybody has to work together with the other departments. So that harmony is very much required now. And if theory will not work now, you have to be very practical, and people are open to ideas with anybody else. So we have in our company the team from all the departments who come together, talk every evening, and they sort out the problems. कि भाई इसको ये हो रहा है, इसको ये हो रहा है, please do it. Or then they discuss this also, that okay, कहाँ किसके family को कहाँ कुछ हुआ है, then go and help them, phone them if they required anything. So such kind of things which we rarely see before it. So what I say, that the teamwork, human relations, people come closer, family bonding, these are the positive sides of the pandemic. So rather than always going negative, we should focus on what positive this pandemic has made. We all came closer. Now there is no problem of anybody for working and for anything. Anybody is allowed to work from home anytime. In our company also right now, with the 50% capacity we are working. So if somebody wants that, okay, I want to work from home, before that, especially in a finance, People say नहीं 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 घर से तो कुछ हो नहीं पाएगा, आपको आना ही पड़ेगा, आना ही पड़ेगा. But that has been changed now. The people say okay okay, you can work from home, you can contact them, come to office. So humor interaction plus safety angle. See, that is a best part which has been happened to all the corporates. That they are now more focused on the safety of the people and everybody, which was really lacking because this kind of thing is never happened. So safety angle has been very important part in every corporate now. How your operational part is also safe for or your office safety, all norms of the COVID is to be followed. So these are the things which now slowly we have learned, and this is how we can go ahead in this kind of a scenario. And I think going forward, now we know how to deal with this kind of a situation. So we will be able to deal it very properly now. Yeah, last year it was a new thing, so people were not aware. There was a cash flow problems initially. Banks were not giving the loan, or even if my limit was there, they were reluctant of giving because they were they were having a fear that whether the money will return or not. But now, if you see after this 6 months or 9 months of pandemic, people are wise enough to do the things. They help each other. Government is also very proactive. RBI policy, interest rate reduced. There are a lot of other ways and means of having the finance from other than the banking. So these are the good things which is happening right now. And as I'm always a positive person, so I find it that because of this pandemic, all corporates are very agile now, and they know how where to reduce costs and how to do the better way of things. And the people and the employees are also in sync with them. So everybody's focus is now same, that do the best thing in this scenario and survive this time. So this is what in a limited time I have to say from the different perspective than the Mr. Mehta and Mr. Subramaniam. That as a corporate, yes, we had a lot of problems in last season, but slowly, all corporate are coming on track, and the corporate are doing their best to survive in this kind of a situations. So thank you very much. If any questions are there, then probably after the this session, I can take up practical questions which we faced. So thank you very much with the good hope. Yeah.
Thank you so much, sir. Mr. Piyush Gandhi is having long years of corporate finance experience starting with GNFC to Gift City. We are very lucky and happy to have such an experienced professional with us here. Thank you so much, sir, for your very informative and wonderful speech.
Thank you. Thank
Now,
you.
before we move ahead, I would like to request everybody present here to switch on their cameras so that we can capture this wonderful moment. Rachna, are we good to go?
I guess everyone needs to turn on the camera still. 2, 3 people have turned on the cameras. People, please turn on your cameras. Purva, please continue.
Okay, thank you so much, everyone. Now, without any further delay, let's call upon our fourth panelist, Mr. Ranjineni Dhananjaya, who is MBA CFA Level 1, PhD NCMP Level 5, and is a NSE Certified Market Professional Level 5. Sir has 20 plus years experience in corporate research and academic institutions in the areas of equity research, stockbroking, and lecturing on finance subjects. He has conducted MBPs, FDPs, and workshops on financial markets. Sir is pioneer in training for NCFM modules, started FR and has started FRM training in 2008. He has worked with Dalal Street Journal, ICFAI, Motilal Oswal, and he has widely lectured on topics like security analysis and portfolio management, strategic financial decisions, international finance, derivatives, and risk management. Sir is the editor of a book on Indian equity and equity derivative markets, ICFAI University Press. He has published articles on insider trading, Japanese corporations in Analyst, ICFA. Sir has prepared study material for diploma in capital markets and has experience in technical analysis software, Metastock of Reuters. He is the editor of a book titled Trading and Exchanging in India. He has attended more than 100 days of trainings in IITs and IIMs on derivatives, security analysis, portfolio management, quantitative finance, econometrics, statistical methods, and commodity markets. Sir, it's an honor having you with us today, and the platform is all yours. And the theme that Sir is going to speak on is latest developments in Indian financial markets. Thank you so much, sir, for being here with us.
Thank you. Thank you for that very generous introduction. And very good morning to all the student friends. And it is a privilege to be invited by Professor Neelam. Madam, we have been studied at for FDP at Ahmedabad. Now, I would like to share my screen in this very slightly different topic, I would say. So let me share my screen. So this is about how the financial markets, what is happening in the financial markets in the latest scenario. Are you able to see the screen, madam?
Yes, sir.
Okay, fine. So if you see the system, what is how the recent developments in the Indian financial markets are evolving because of this recent, I'm talking about the past 2 years from the onset of this COVID pandemic. Let me see, because as all of you know, let us see the backdrop. It is all history. Now that the first COVID-19 positive case is registered around 30th January 2020. And with effect from 25th March 2020, so the government of India declared a countrywide lockdown initially and extended to May 31st. So that means, it seems a very long period now because of the lot of stress involved in these, lockdowns. Our earlier speaker from Gift City is very apt that because of international finance conclave, You have invited right people from Gift City. Even I have visited. It's very wonderful place. So even some negative aspects are also there due to this lockdown. Not only the family unions, and I have seen some family breakdowns also because of people are unable to cope up with the close proximity the lockdown brings. So that is a lighter side of it. And as you see, this some of the ironies are happening. That ironies are stock market has seen more gain than pain in the post-COVID phase. So that means, as the people experts say, the stock market is the most comedy theater. So it is a lot of surprises happen in the market, and people are always people. We as persons we try to look back, whereas stock market looks forward. So stock market is the greatest discounting mechanism. Millions of minds are working together, and we have to recognize that as students. And I feel always privileged to talk to students from Gujarat, the Ahmedabad. That is where a lot of finance experts are there. People who they by birth they understand the businesses, they understand the stock market, financial markets. They participate in that as a sort of a home-based enterprise. So I'm very much privileged to speak to my student friends from our Gujarat and Ahmedabad universities. I'm very much privileged for inviting me by Dr. Neelam. Now, if we continue, I think let me share full screen. So if you see some of the statistics I would like to share and try to give you a summary of how it is happening. Now, if you see this before COVID, that is how the Sensex moved. So something like 13% gains. And after COVID, if you see there is if you see from January 20, it is around 24%. But if you see from the lows of 25,000, it is almost doubled. So 100% gains we have witnessed. So that is a very surprising thing to normal people. But stock market participants always anticipate the future before it happens, and they try to benefit from that. And if you see how things have happened in the market, this is health concerns and work from home. These have made some of the sectors very popular winners among the these companies. That is pharma companies and IT companies. They have become winners, huge winners. People have become double, triple. Some of these pharma and IT companies. So the very thing in the very important thing in the stock market is we all know what happened in the stock market after 3:30, but we don't believe what is we don't believe, and we can't accept the things when we are in the trading situation. That means even though we know that these IT companies and pharma companies are progressing very well, but we tend to disbelieve when the events are happening. So that is a very remarkable thing about stock market is everybody wants to buy if the stock market goes to say 30,000 or 35,000. But when that thing happens, everybody becomes fearful because it may go down. So that is an important feature of speculative markets, that whenever an asset keeps going up, it keeps going up. Whenever an asset keeps going down, it keeps going down. Now you see this the cryptocurrencies, Bitcoin, huge volatility, huge fluctuations. And now from 5,000, 10,000, it has reached 50,000, 60,000 Bitcoin. So that means the momentum has its own way of sustaining itself. So that's what we call reflexivity. As you know, some of the great traders like George Soros explains how the positive momentum builds up on its own. So are what we call self-fulfilling prophecy in markets. So when you start believing it, it starts happening. So it has its own momentum, it has its own force to it. Like I can give some example. If a stock price, if the company stock keeps rising, it has its own positive impact, positive benefits to that. The company can issue new shares, new equity shares at a lesser cost of capital. So the company will get a lot of benefits from an increased share price. The share price itself is a currency for the company. So the company has a lot of benefits, positive feedbacks arising from a strengthening stock price. So that way, I think we have to, as students, you have to understand correctly how the market structure is there, how the market microstructure is there, how the basic principles of stock market. Like we have in the stock market, an auction market. So how the buyers and sellers are behaving, what is the psychology behind it, these type of things we have to understand. And particularly in this pandemic scenario, there's a lot of extreme emotions are playing. So now you see how the volatility has increased in the markets. From we have a volatility index called VIX. So we have an Indian variant like India VIX. Now it is around 20. But when you see in the pandemic crisis, it has shoot up to around 70 to 80 levels. So the 70 to 80 levels is the highest we have seen in GFC 2008, global financial crisis. So that type of volatility we have witnessed. And it is in volatile situations, our mind becomes numb because of huge fluctuations. It will become a lot of the investors biases, investors hidden fears will come into force. So now if you see that some of the changes or what happened is in this pandemic also, a lot of positive things also have happened. A lot of individual investors have opened new accounts because of work from home, because of their free time, because as you know, the stock market is thing which is considered as an essential service. So apart from others, stock market is the only thing which kept open throughout the pandemic or lockdown situations. So that's, I think that has encouraged a lot of people to invest and try to learn from the stock market, learn about stock market, investing. I think that is one positive spillover, or what we call unintended consequences of COVID-19 or lockdown. So people have learned about this financial mechanisms and how this happens. Financial literacy has gone up because savings, people learn a frugal living and with less extravagance and all these things. So this is one of the, and as you know, now we are facing second wave of COVID, and this is also very tough situation, as you know. And the second wave of COVID, there is some amount of hesitancy in the markets because some of the reasons like treasury yields are going up and a strong dollar, and we have a vaccination also, very small vaccination. We are around 1%, whereas we're around 5% vaccination, whereas developed countries around 50%, like UK, we have 50% vaccination. And resurgence of COVID-19 infections, and we see the default of a large US hedge fund. Some you might have seen in the news about Huang, who lost $5 billion in 3 days, I think. And so, and 10-year benchmark yield around 1.75%. So when bonds prices, bond yields goes up, there is a very negative impact on the stock market prices. So there is that inverse correlation is there. But RBI is continuously supporting the market because they have various tools at their end, like open market operation twist. There's a lot of forward guidance and how they are going to manage inflation, how they are going to manage the tinker with interest rates. Some of the fears of the market is that if we, because interest rates now if you see, in the US market, the interest rates have gone down to negative. So there is a fear that if the interest rates are raised again, and how they are going to adjust, because the stock market may collapse if the Fed tries to raise the interest rates. So they are trying to grapple with that, and we have to see how the situation unravels. And because the market does not react to these known things. So even though it is a, because it's not as a known thing is not a black swan. A black swan event is something which happens unknown to you, or as they say, unknown unknowns. So that type of things you have to keep in mind when you are dealing with markets, when you are studying markets, understanding markets, and interpreting markets. So always interpreting market is market is good by hindsight, but when you want to deal real time, it is very difficult. So some of the things which came into play to adjust to this pandemic and COVID-19, that is the use of circuit breakers by the exchanges. And as you know, exchanges employ several techniques, including market-wide circuit breakers, trading halts of individual instruments. Because a lot of volatility is there. We have seen two upper circuit breakers, lower circuit breakers. Because if the market falls by 10% and there is a trading halt of 1 hour. So that we have seen in several cases during the first wave. So these are all how stock exchanges adjust to keep a smooth price discovery mechanism. And there's a rise in market speculation where a lot of margin adjustments, and now SEBI is tightly regulating the players and decreasing the limits. Earlier, before 6 months, we are using 10 times limits. Now we are down to around 4 times, and still will be going down to 2 times and 1 time by September 2021. So some of these things, I think, what are the safeguards used by the financial markets? Now you can pretty well be clear that we are in financial markets, we are safe. That is from counterparty risk. So market risk is always there. But SEBI and other players, they strictly enforce the market clearing mechanism. So this is how, but we should be sure that we see the data. There's a second wave of COVID is somewhat slowing down Indian equity markets. As you see how the performance is there. 1 year performance, very huge performance is there, around Nifty 50, 70%, whereas year to date is only 5% increase is there. And if you see sectoral performance, there's a lot of sectoral performance. We have seen IT 100%, metals 150%, huge performance in metals, and bank and auto also, because they are heavily beaten down. Because of a lot of fears of lockdown, fears of production in disturbance. So all these things, if you see how the sectors are adjusting themselves. So what we call in finance, a sectoral rotation is there, depending upon how the market perceives which sectors are performing well, which sectors are they're at a disadvantage. So this is how you can see the Nifty sector performance. And also, one key is the variable we have to watch is 10-year government securities yield that is coming down. So the one real threat to the stock market is if the 10-year yield tries to go up, then I think there will be some sort of mayhem in the stock market. But I think the big people will be watching, like your central banks. So central banks like RBI, Fed, and all these people, they will take coordinated action so that there will be smooth adjustment to a increased interest rate environment. Because however, it is now at historical low and negative interest rates in other countries, we are still at around 5%. But because our inflation rates are 5-6%, so that means we are also at a real negative rates, even though it is appears we are the positive rates. So this is how This RBI or central banks are commitment to maintaining an accommodative stance. That means, very monetary policy, loose monetary policy, are very flexible, so that liquidity is not tightened. So adequate liquidity system, so to not allow bond yields to rise. So if you see the overall net inflows of FII, strangely, very huge FII inflows have come in this pandemic period. If you see this red line, shows you that FY21, and that type of FII net inflows are huge in this situation. And overall, DIAs are selling heavily. I think that is observed by the FIIs. And one strange thing is a huge monthly turnover. Now you see the lot of retail participation and coming, and total monthly turnover is huge. So now we have around average of 30 lakh crores per day. If you combine equity and derivatives, notional turnover, there is a huge turnover in the NSE. That is also one positive one, where in terms of number of contracts traded, NSE is number one derivatives exchange or equity derivatives exchange in the world. So you can see the total turnover in the different segments. We have basically cash segment and future segments, and we have different instruments traded in NSE, like cash market, stock futures, and index futures, and stock options and index options in the equities side. So we have huge interest in this, basically Nifty and Bank Nifty. Huge amount of trading is going on, and new instruments like weekly options on Nifty and Bank Nifty, they are hugely popular. And particularly Bank Nifty is hugely popular because of lot of volatility is there, lot of fluctuations are there, weekly options are there. It is like playing a big lottery. It's playing a big casino. If you see the weekly options, it's a highly volatile instrument, and there is a lot of opportunities for students to study these instruments, to benefit from these instruments, to work in these instruments, for as a firm or as an individual. Or I think I need not, particularly students from Gujarat University are no strangers to these financial markets. And I think this, if you see the average daily turnover, huge turnovers are witnessed in this past 2 years due to this volatility, and also due to work from home and access to internet, and availability of time, availability to study. So all these things contributed to huge turnover in NSE. So these are all some statistics for you to think over. And as we have discussed, a lot of turnover in the internet-based trading. Huge trading has happened. And also you can see the reason distribution of new investors have increased heavily. So I would like to summarize this presentation. The key observations, what we see, because of these, a lot of markets do the most obvious thing in the least obvious way. That means we expect something, but it doesn't happen like what we expect, but it ultimately happens, and that there is some delay in the market reacting to what you expect. So always surprise is the weapon of the market. It's like, the market surprises you, and market, hits your stop losses, and market takes you out, then it goes in your desired way. So that is one characteristic of the market. That's why we call the cruelty of the market is unlimited. The market is very cruel to participants. There will always be short squeezes, and all these things will happen unless the player is well capitalized. So that's how all these things have to be. Human psychology also has to be studied by the students of the markets. So the market, you have a lot of things in the market, like, it has got deception, it has got camouflage, it has got comedy, it has got tragedy, surprises, violence, torture. If you are in a wrong position, you will get continuously tortured unless you give up that position. Once you give up that position, it starts to go in your way. So that type of extremes are possible in the market. So financial markets go to the extremes, away from Gaussian distribution. That is, no, you have never seen 10% fall, 20% fall. Never expect, because of your assumption is that the market returns follow a normal distribution. So plus or minus 3 sigma moves happen more than what you expect from your models. So that's what we call a black swan events. And how this black swan has basically 3 characteristics. That is, it is very rare, and 2, when it happens, it has a large impact, and the third point is it is always explainable after the event. Very rare, large impact, explainable post facto. So that's why we have seen a lot of newspapers writing about due to this happened. A lot of TV journalists coming in onto the TV at 3:30 and will be saying this happened like this due to this. This is all very very uncomfortable. So we don't need description. We want prediction. So description is different, prediction is different. So description anybody can do. So you want to develop quantitative techniques to predict what happens and to manage your risk when you are in a position. So that is how you have to understand statistics, quantification, and also psychology. So that's why there is a very powerful mix of statistics, psychology, and human emotions. Then only we can understand properly market and participate in that market, because it's a highly competitive, hazardous, and dangerous marketplace we have. Financial markets are like that. And as we have seen, tail events are the norm, and stock market is a discounting mechanism, because it is always tries to discount the future, whereas we try to look back. So there will be some disconnect. So right now also pundits will be saying that there is a lot of human tragedy, why market is going up. So that is where the disconnect is there. And if you start asking why, the market will attack you. So you should not ask why in the stock market. You have to go with the flow, or you have to keep quiet when you till you properly understand. So this is all, we see the historical statistics also, human tragedies are ignored by markets, as witnessed in the previous pandemics or wars and viruses, flu, all these things. If you see how the market reacts after the event, and how the very positive, highly positive returns are given by the market. So there is a book called Triumph of the Optimists. How the optimists always it is giving huge returns when the stock market, that is, investments are held for long term. So markets reward investors who take risks and invest for long term. And I think as appropriately titled, I'm very very happy and surprised by the title. Is very nice by Dr. Neelam. The resilience and importance of financial markets is witnessed during this COVID-19. Thank you very much. I think I hope I have not exceeded my limit, the allotted time. Thank you very much.
Thank you so much, sir, for your wonderful insights and conducting a very informative session. Now, let us call upon the 5th speaker of today's panel, Professor Narayan Basel, who is the Associate Professor of Petroleum Management, PDPU. Sir has a PhD in Financial Management, has done his MBA in Financial Management from Hemchandracharya North Gujarat University, and has done his BCom and MCom in Advanced Accounting and Auditing and Accounting and Finance. Sir is here to talk on the theme, Financial Resilience and the Pandemic. Sir, we welcome you, and we are really lucky to have you on the panel today. Thank you so much.
Thank you. Thank you for a very generous introduction. And I'm very thankful to Gujarat University, B.K. School of Business Management, and Dr. Neelam Panchal for inviting me on this International Finance Conclave. And a very, very apt topic, as said by Dr. Dhananjay in the previous presentation, financial resilience and the pandemic. I hope my screen is visible to everyone.
Yes, sir, it's visible.
Okay, fine. So just remind me of the time if I take more than 20 minutes. I'll be focusing on the financial resilience and pandemic as a talk for the 2 days, and the agenda for my today's talk is there are 3 agenda that I set up in the next 20 minutes of time. In fact, my previous speaker has set the ground well in terms of talking about the fintech, and then the relooking the entire financial techniques, and then the other speakers talked on the stock market and the other things. So I think now it's time to understand the financial resilience in the context of economic downturn by COVID-19 and its key message to the global financial system. So first a few slides I'll be talking on this. Then we'll move to analyze the key investment policy areas and the central bank's measures or the response to address this pandemic, and then building the financial resilience. And finally, I'll talk on to re-examine the role of risk leaders in reposition the risk functions in response to COVID-19 pandemic. So if we talk about financial resilience, what do you understand by that? So you can see on the slide the very, very simple definition. In fact, many definitions are there in the literature, but this is what I like most, that financial resilience is the ability of a financial system to withstand, adapt, and thrive in the face of shocks that are internal and external, as well as known or unknown or unanticipated. Now here, let me just tell you that resilience is the word which is used in many contexts. It starts from individual and it may end up to the economy at a global level. So today, I'm not talking about the financial resilience at individual level or the investors level, but my focus more on in international finance conclave, I'll be more talking from the global financial perspective. So I'm here talking in terms of the economic system, the financial system of the country, how country's financial system is responding to this kind of pandemic situation and building the financial resilience so that they can adapt and thrive these shocks, because these shocks are very exogenous shocks, external shocks. No doubt we are absorbing since long so many internal shocks, but this is the time where there is a external unanticipated shocks in the form of this COVID-19 pandemic. So to start with, let me just give you the global overview of the economic decline in the second quarter of 2020. Now, I have taken this particular slide from the Joe Hassel's, September 2020 presentation, where he talked about which countries have protected both health and economy in the pandemic. Very interesting article that I have gone through. And I like this article because in the coming slides, I will tell you why. Now, the scale of economic downturn, if you look at, then, the country like Peru, which has suffered a lot, minus 30% economic decline, to a country, Taiwan, which has only faced 0.6% negative or decline in the, their economic activity, GDP especially. Now you have a range of economies from Taiwan, South Korea, Finland, Norway, Indonesia, Israel, Sweden, Denmark, Romania, Cyprus, Austria, Canada, Portugal, Malaysia, Italy, Mexico, UK, Spain. Every country has responded differently in terms of GDP decline. So now one thing is the impact of this COVID-19 or this pandemic, it has resulted into GDP decline. But the every country's percentage downward, figure is different. Now this is one key takeaway that you should have. Now what the key message that I am getting from this graph? Essentially, the COVID-19 pandemic represents the biggest test of the post-crisis financial system till date. This is what I feel, because we have seen global financial, crisis. We have seen the 2008, then, even the previous Asian economic crisis, and many crises we have seen. But this is the crisis which is, very widely spread. Now it's second year, second wave. Still things are not settled down. So it's the biggest test of the post-crisis financial system till date, as per my opinion. And it constitutes an unprecedented global macroeconomic shock, pushing the entire global economy into a recession of uncertain magnitude and duration. Because still experts are not telling any deadline in terms of, okay, this is the line, this is the date by which everything will be normal. Now we are saying nothing normal. Now we are saying new normal. That means now we are not expecting the earlier normal come again back. It's now about new normal, living with this kind of things only. And the third important thing is the global financial system. The global financial system faces the dual challenge to sustain the flow of credit amidst declining growth and to manage the heightened risk. Now, there are two problems. In the first graph, we have seen that the GDP is declining, while the second thing, risk is rising. Now, this is a very, very critical situation wherein we stuck up. Now, the question, the second point which I would like to take from the same paper of Joy Hassel, which he presented in September 2020, and he pointed out a very interesting story that this is an illusion of trade-off between health and economy. Now, this is where everywhere now we have been criticizing, that why there is no lockdown. Why there is no lockdown? Earlier we had a lockdown, now we have no lockdown. And these things are facing not by India, but every country. So now, do we really have a trade-off between health and economy? If you look at the statistic, a very interesting graph on the screen from our world in data, that we have a confirmed death per million, and on the other side, GDP growth from previous year, 2020, second quarter. Now, if you look at this data, very interesting story coming out that there is nothing like a trade-off. That means the countries who have focused on economy had a very, very bad impact on health in terms of the death rates, or those countries who have focused on health, more, they have deteriorated in economy. Now, do we have such data with us? If you look at this data set, then see from Peru to Taiwan. Peru, highest decline in the GDP, -30, and highest number of death. There is no trade-off between health and economy. Look at the Taiwan, lowest death rate and lowest GDP decline. Where is the trade-off? And in fact, if you look at the countries like US, Netherlands, Romania, Japan, same decline of around 10% decline in GDP, but resulting into a different levels of death. Different level of death. US highest, while Japan lowest, the same decline, but the death health-wise it is different. There is no trade-off. Look at on this side. If you look at the number of death as a constant, like say 600, look at the different countries like UK, Italy, China, and US. If you look at that way also, then even the death rate is stagnant, but the GDP growth in terms of decline is different for UK and US, in between Italy and China. So now the question arises is that really we do have a trade-off. We do not have a trade-off. That means notice that countries with similar falls in GDP have witnessed very different death rates. And that's where there is really no trade-off between health and economy. We have to deal this problem in a very different way. Because if there is a proper trade-off between health and economy, we could have solutions. But here, the data international level shows that nothing guaranteed, and that's where everybody is now, having issues. Where does India stand in terms of the GDP growth? If you look at this particular slide, which is from the International Monetary Fund, the September 2020 data, I'm showing you that if you look at, look at this, the lowest in terms of, highest in terms of the decline, we are at last, India. minus 25%, decline in the GDP from, with the quarter April to June, second quarter of 2020. I'm talking about this last year data. We have the updated data now coming up, and probably we could get in this next June 2020 second quarter data also with us. That will tell us the different story. But if you look at the other side, there are countries like China. China didn't have any impact. Now, this is a very interesting thing to debate on, but we are not debating on that part right now. But we have a country like Korea, Indonesia, Australia, very less decline in GDP, but the country like India, Britain, Spain, Mexico, we suffered a lot in terms of the GDP decline. Now, my second objective for today's talk is now where, as a country, what we should do in terms of addressing the situation and building the financial resilience. So what are the investment policy areas? So I have identified 3 important areas. Country like India can think in terms of the policy decisions. Now, this is the time to address this pandemic and building the financial resilience for the country like India. We must have investment facilitation, investment incentives, and third, very important, which has been ignored, but now people have understood, the medium small enterprise, micro, small and medium enterprises, MSMEs. So now we have policy areas. If we talk about the facilitation, we must have the administrative framework or the bureaucratic framework that actually facilitate the entire process of investments, rather than creating an obstacle in terms of the registrations and all these things. Now we are observing, like, look at the Gujarat University, who has built up this COVID center in a very, very less number of time. If you look at the GMDC ground, 200 bed plus, with all ventilator and everything in a very, very, very short period of time. Now, this is the kind of administrative supports, bureaucratic supports we require in terms of even the big new investment which are coming up. Then using online tools and e-platforms. Now, this is very interesting because in the pandemic time, when we are being forced to do a social distancing for the sake of our health, that means we have to find out the ways that we should not get any delays because of the offices are closed. Because say, okay, sir, your file is there in the office, I can't do anything. Those things now we cannot afford. Everything should be on the online mode, on the e-platforms, all the sanctions and everything. So that kind of, things we required from the government side in terms of preparing the policies on those particular areas. Second thing, incentives. That's very important. Incentives were there since long. It's not a new story. But now we need to look at those incentives from the very, very special, COVID-19 perspective. And I think our government is doing quite well in terms of giving a lot of, incentives to come up with this medical equipment and other things. Like in the last 1 month, if you looked at, then we are talking about even oximeters. If you go to the market, any medical shop and ask for oximeters, they are not available. Now, what we were doing, do we have the enough infrastructure to speed up the process of manufacturing oximeters in a very short period of time? So those incentives, some schemes should be there. Cylinders, oxygen cylinders, these things which come up immediately, then our, the industries should be ready in terms of, doubling their capacity or getting some incentive from the government side or the policy side. I'm not saying government policy side, so that, conversion of production happens in a very, very efficient time. Very, very, less time we can convert the facilities. And finally, local supply chain. That, in fact, this pandemic has, given one very strong signal about the local supply. In first lockdown last year, we could have understood that no, people here, then only things get settled. So medium, micro, small enterprises more proactive to build the financial resilience and dealing with COVID-19 pandemic. Now, my next point, it's what is the role of central bank? We have a Reserve Bank of India, like every country, US as a federal bank. So what are the prudential measures that these central banks should take so that they can address this pandemic well and build the financial resilience for the country like India? So I have sorted out from one of my reading that these are the 5 points on which government can think of, the central banks, RBI can think of. One is interest rate, that the policy rate cuts. We have a bank rate, PLR, repo rates, all monetary tools that we talk in economics. That can be a very, very good tool to deal with this kind of pandemic by easing liquidity or tightening the liquidity, along with the general liquidity provisions that we have in terms of CRR, cash reserve ratio, or statutory liquidity ratios, or any specialized lending for that matter. Along with that, government also think of selling and purchasing of the assets like government bonds and the corporate bonds that can also give a lot of boost to the economy in terms of liquidity. Then lot of forex transactions, and finally prudential rules and regulations. Out of all these, the last one is very important because we have to also look at the kind of system that we have, financial system or the banking system, that do we have a whether our banks are strong enough to sustain in this pandemic time? Do they have enough financial resilience in terms of capital requirements, liquidity requirements? So these are the areas which I think should be addressed very quickly and come out with the policies. Now let me show you the case of one particular case of US Dow Jones Industrial Average. If you look at this timeline from February 14, 2020 to April 21, 21, if you look at, this is the event, 23rd of March, Fed Bank, US Central Bank has announced new lending facility. And look at Jones' point at that point of time. It was the lowest since, it was the lowest since February 14. And after just announcement of this Fed policy, central banks, policy, look at the market, how the market behaves, and then Congress passes stimulus package and again market behave positively, So this is how, the policy reactions are there. These policy reactions could be studied properly in terms of, the responses that you are getting from the market. Then what if a banking system moves from cushion to caution? Now, this is a very interesting slide from the McKinsey. What they did, they have taken the common equity tier 1. I think those students who are from the finance background, they know the Basel norms and the tier 1 capital, tier 2 capital. So if you look at the tier 1 capital ratio, common equity tier 1 ratio, then they identify 3 zones, cushion zone, caution zone, and danger zone. So if your CET tier 1 ratio is less than 5%, you are in danger zone. If it is 6 or 5 to 8, you are in a caution zone. And then if it is, 10% plus, then you are in the cushion zone. So now our banking system is moving from cushion to caution. And the moment it moves from cushion to caution, it will not take much time to move from caution to danger zone. And this is where the Reserve Bank's role is very, very essential. Not only Reserve Banks, but I'm talking the global perspective of the international banks and all this, that we need to look at the viability of the provisions in terms of the sustainability of these banks in the longer run. Because now we cannot afford any collapse of banks in any country, not only India, but everywhere. So this is very interesting thing. Now, what my point here is fiscal space. Now, this is the only area where, very, very essential to build the financial resilience. Sorry, Neelam ma'am, am I audible enough? I'm going well. Hello.
Perfect, sir.
Okay, fine. Because what happens in this online, I cannot see the screen. I can see only my PPT on my screen. So that's the reason I just asked. So I'll take 5 minutes and I'll wind up. So fiscal space. Now, this is where, why we need fiscal space as a country, because the domestic resource mobilization, efficiency in the public expenditures, then public investment and debt management or the public-private partnerships, and debt financing only for the projects with a high rate of returns, developing financial buffers, because most of the time when we talk about the fiscal space, it is all about the public debt by the economies. That's how we create the fiscal space. That is essential. But again, let me show you how government is responding to this pandemic in terms of the fiscal space. So this is one very interesting data shared by the economist in the August 2020, when this, the government's response to the COVID-19, and they actually identified 3 categories of the economies: advanced economies, middle income economies, and low income economies. And the spending response, if you look at advanced economies, are spending massive in response to the COVID-19 government fiscal response as a percentage of GDP, this data is, and low income countries have a very, very less fiscal response. Now, this is where the impact would be different if the fiscal response is different. But caution, if you look at the emerging market economies, little space to run budget deficit among those emerging market developing economies that entered 2020 with very high debt to GDP ratios and very high sovereign spreads when the COVID-19 recession hit. Let me show you one graph, very interesting graph from the this International Monetary Fund IMF blog. This blog was published in August 6, 2020 last year, but it has given a very interesting finding of the worrisome lack of fiscal response, because 1/3 of the emerging market economies have limited room or no room for the fiscal policy to counter these prolonged crises. Look at these red points. There is no, they are at risk, because high debt to GDP ratios in 2019, when you already have such a high level of debt to GDP ratios, it is essentially, or say you can say that it is really difficult for these countries to run to have the fiscal space to deal with this crisis. And this is a very, very alarming situation which IMF has, given. Now, another important thing, during the same time period, if you look at this, is a very interesting, article written by Blow in the debt pandemic, on the title Debt Pandemic in 2020. And he had given a very interesting chart, that is, downgrades of the sovereign debts in 2020. Now, all rating agencies, that Moody's and Standard & Poor's and Fitch, these are all international rating agencies, and they used to do sovereign bonds rating and sovereign ratings for the debt. Now, if you look at, they have downgraded it. But if you look at the highest level of downgrade is happened in January 2020. And this is what I'm saying you, because it exceeded 1982 international debt crisis, which we all students were discussing in the international finance course. 1997 Asian crisis, it has gone. Global financial crisis 2008, which was less than 20 or nearly 20%, but now look at this now. This time the score is somewhere around 30. Now this is where the caution is there. Now this is where I would like to have one more slide on this, that how the portfolio outflows of emerging market during this pandemic. So now that all the countries like India or we countries, emerging market countries, we more rely on the portfolio investments in terms of the FII or something like that in our countries. Now look at this graph. This is another very interesting finding, that portfolio outflows from the emerging markets when the COVID-19 crisis hit, that exceeded all previous one, be it a global financial crisis or be it a taper tantrum, which was in 2013 in the US, when they they applied some quantity easing in the monetary policies of their country. So now see, this is the highest one. It has actually surpassed all our previous records. And this is where I need to re-examine my last point. I need to re-examine the role of risk leaders in response to the COVID-19 pandemic for building the financial resilience. So I have 2 points of advising when I say re-examining the role. Risk leaders can take initiative that should help them reposition the risk function. Now, this is very important, repositioning the entire risk function and building the future-oriented strategies. Now, risk leaders need to think on this and also look at the forward-looking approach, the proactive roles. That is very, very important. Now, this is the question that I would like to give to the students, that what strategies do you suggest to help risk managers move forward in response to pandemic and building financial resilience? Constantly think on this, guys, because you will be tomorrow in the industry. And if you want to differentiate yourself from the crowd in the industry to shine it out, you need to think on this question constantly, that what strategies we can suggest to these risk managers in response to these unanticipated events for building the financial resilience. You can think of, I'll give you some points. How do we reposition the risk function? So these are the points. I'm not speaking out them. These are on the slides. You can read out them because of the time constraint. I'm not explaining you all this. But then the second wave of COVID-19, which we talk on, and in India, I think scientists have already told about this third wave. Now, things would be very rushed. Then it's a time to think about, our risk function. We need to identify that which are the assets which are most valuable, mission critical. How do I devote my resources? We have never thought of devoting resources towards these things. Now it's a time, the first time I bought oximeter in my family. I never thought of putting some budget for buying oximeter. At individual level, same thing can happen at country level. Country has to identify, enterprise has to identify, company has to identify which are the most valuable assets. So these things, because of paucity of time, I'm not able to talk more on this. But please, friend, look at these points and try to understand that in future, when you move into the industry, how can you reposition the risk function of your industry, your business, your company, your country, and that will make you a differentiated guy from the crowd. And that's how. So I'll end up with this small 1 minute 39-second video by ENY, and they talk about the enterprise resilience framework to deal with COVID-19 crisis. So let me run this video if it works. Neelam ma'am, can you please update me that? Would you able to see the slides?
Yes, sir.
Shall I play the video? Is sound audible?
Yes, audible. You can increase the sound if it is possible.
Okay, let me do it if I can. Speaker is showing 100%.
Okay. Not audible for now, sir. Yeah.
So that's EY's framework for the better enterprise resilience. and then same can be applicable to the the resilience for the entire country and at individual level too. So that's all. Thank you so much for your time. Thank you.
Thank you so much, Professor Narayan Baser. And thank you for taking us through the journey, combining the topics financial resilience and the pandemic. You have given us all something to think about by showing us the reality of what has been happening in different countries as well as our nation in the past 1.5 years. So thank you so much. It was an honor having you with us here today, sir.
Thank
Now,
you.
I call upon the sixth speaker of the panel, Mr. Chirag Gyara, who is a banking professional with over 20 years experience comprising India and abroad in the area of corporate banking and financial markets. Sir is here to talk on the theme financial services and challenges. Sir, we welcome you and the platform is all yours. Sir, kindly unmute yourself. So we can't hear you.
Yeah, thanks,
Sir, you're
Purva.
on mute.
Thanks, Dr. Nilam Bachchan, for giving me this opportunity. Uh,
So Chirag sir will join again. If anybody has any questions to Professor Baser, Professor Gandhi, and all the speakers so far, you can ask for now. Meanwhile, Mr. Chirag will join again. Any students, any questions?
Yes, Sonam, you are raised your hand. You may go ahead.
Yeah, actually, I have one question. That's finance is very wide field, and we have seen that how all the speakers have given us the insight of the finance sector. So I would like to ask that how, if we are choosing this field, and how to set apart from and how to differentiate ourselves from other people choosing the same field.
I request Professor Baser if you can throw light.
Sure. Yes, guys. In fact, in MBA, we have been a lot of studying, the strategies like cost leadership and product differentiations, all these things, and that equally applicable when it comes to yourself, because you are also a product as such in a market when you join the companies. So differentiation, when you talk about it, is, you are all learning the same thing. All professors teach you the same thing, same books, everything. So now where the difference lies in your own understanding and application of the concepts. You all learn NPV, IRR, profitability index, everything. But then when it comes to applying the concept in the industry, where the student missed out. So if you want to really differentiate yourself, then, think little out of the box, read between the lines, look beyond the boundaries, and try to understand the application part of the theories that you learn. You don't just repeat the theories, but rather, as Dr. Shantanu's presentation, he has mentioned one very interesting thing in the last slide, that it's you, like that is the only thing. You are the only differentiator, not your textbooks, not your professors. You are the only differentiators. So you have to think You have to think that how in the given situation, whatever the knowledge that I have gathered is applicable. Wiser decisions. You have to be wise man. That's the only differentiation that I would suggest. Otherwise, in terms of knowledge that everybody has, but when you create your skill set, then I think you are differentiator.
That's true.
Yeah, thank you so much, sir.
Yeah, I think Professor, please, thank you.
Professor Chirag Gyara has been able to join us again. So, sir, we welcome you once again, and the platform is all yours.
Pura, am I audible now?
Yes, sir, you are.
Acha. Yeah, thank you so much. I think I'll just turn off my video. Perhaps there's a bandwidth issue.
Sir, you might want to try with your, without your earphones.
And I'll start presenting.
Okay.
Yeah. So you are able to see the screen now?
Not yet, sir.
I think you need to put on your camera.
Yes, I hope now you are able to see the presentation now.
No, sir, no.
Hello, Pura, you are able to see the presentation now?
No, sir, not yet.
Chirag, I think your camera is off. Just check that.
Is it audible now?
Not yet.
It is audible and you can carry on, but your camera is off, so we're not able to see that, but then you can carry on. It is audible. Okay, so meanwhile he joins, is there any other question to anyone?
Yeah. Yeah. Okay.
So Mr. Chirag is joining from other device, and meanwhile we can take Ms. Niyati Dave. Purva.
Yes, sure. We have the honor of having with us Ms. Niyati Dave, who has 6+ years of professional experience spread over academia and startup advisory. Ma'am is currently associated with Supiva Advisory Group Limited in client-facing and advisory roles to help startup raise capital. Her focus is on raising impact and SDG investments for women-led startups. Ma'am is here to speak on the theme Impact Investments. Ma'am, we welcome you and the platform is all yours.
Thank you for the generous introduction. Am I audible and visible?
Yes, ma'am, you are.
Great. So please feel free to interrupt in case my voice or my video drops off. At the outset, I would like to thank Dppg, Gujarat University, and Dr. Neelam for inviting me to this talk. It is an honor to be able to share the virtual space with dignitaries of this stature. Also, I feel nostalgic to have on the panel my mentor, Professor Shantanu Mehta. Regards to you, sir. I hope and wish everyone who is attending this talk,
Thank
you
you.
and families, thank you, sir. I hope you and your families are keeping healthy amidst this pandemic.
Absolutely fine. Absolutely fine.
Great. So let me begin by saying that the impact investment space is not something which is new. Impact investing as an activity is not very recent, but the splurge in the impact space is young. All of us were aware about our social placements and roles. It's only events with long-lasting adverse effects like this pandemic that shakes us up as a society. It also ponders to think and more than think, make us actually realize the things that we already know and feel. The consequences of capitalism are unfortunately so great that the government alone can't cope up with them. Argument is that there are philanthropists who can share a shoulder as far as societal issues are concerned, but they are a very small part of the proportion, who further offer a smaller percentage of capital to various social issues. So then the question remains, who offers a credible solution? And according to the experts in the space of impact investment, they say that it is not any one person, but it is a combination. The private sector, who up to lately was only expected to generate profits, has to now come into play where they should look at profit with purpose. So I'm sure with the current pandemic, we already have realized that we cannot look up to governments alone to solve these social problems. The private sectors and the individuals have to move the needle. The capital that runs the economy, therefore, must be purpose-driven. Philanthropic capital should be working with private capital aiming to achieve profit with purpose. This is when we start looking at socially responsible finance, also known as impact investments. So basically, impact investments have challenged the long-held view that social returns should be funded by philanthropy or by government, and the financial returns should be funded by the mainstream investors. But as the space grew, a realization dawned that investments can have a fairly good financial returns, and at the same time, it can positively impact the society. So that is where there is a shift in the way the investments are being looked at. Mindsets are changing. And instead of simply focusing on risk and return, it has now started to accommodate risk, return, and the measurable impact in order to achieve those returns. So not only the investment community, the entrepreneurial community out there now also has started thinking that if I want to create a business, let it help people's life beyond the traditional lens of employment generation for which we appreciate entrepreneurship. In a couple of months from now, maybe the definition of unicorn itself may alter. A company that is worth $1 billion and company that is touching lives of billion people. So now we view these kind of unicorns not just with the kind of profit that they are creating, we also view them with the kind of impact lens they use to create this profit. So I'm sure you're observing a shift in the way the products are innovated and how these startups are changing from being just mere tech startups or manufacturing startups or service startups, they are now becoming tech-enabled impact startups or service-enabled impact startups. Technology coming into health has completely changed the diaspora. Technology is a big time enabler, which is easing the impact which is created. So technology coming in way to help the visually impaired. Now, before a couple of years or maybe before a decade, we wouldn't have thought pairing technology to help the visually impaired. To take one case, a company founded in 2010 in Israel, Jerusalem. It was bought by Intel at a valuation of 15.3 billion US dollars in 2017. The name of this company is Orcan. The genesis of the firm is very interesting, and I would like to mention that here. The aunt of one of the entrepreneurs was partially blind. She asked her nephew to help her. Several years later, he found his technology had reached such a stage where he could help his aunt. So he created a pair of spectacles with an attachment that could whisper into your ear. Now imagine its applications. The page of the book you are reading, the name of the street sign, the street that you are crossing, the bank note or the currency note that you have in your hand, the goods on the supermarket shelf. I mean, it ranges from a broad variety of implications. Imagine what kind of blessing it would have offered to people who are suffering from dyslexia, or the people who have some kind of difficulty into reading or are partially blind. Company has raised $100 million so far. The last round, that was in 2019, was an IPO, and it was valued at over $600 million valuation. A valuation non-impact business would have loved to have. Even here, to illustrate how the impact lens that can be brought into action, one can always ask this question: how can I help maximum people? It takes you then beyond blind people. Maybe it takes you into saying that, what if I use the same pair of spectacles and give it to every illiterate person in the world? Can that enable them to have a higher paying job? Can this thing improve the lives of their families? Can this thing help them earn more income? So I have worked with a firm which was originating from Zambia or Africa during my association with Supeva Advisory. This startup aimed to give small farmers a platform to raise the marketing opportunity and to ultimately sell their products and export them at a fair price. We helped them raise impact capital, and it was very interesting to understand how their small efforts of such a startup could improve the lives of small-scale farmers across Zambia and later across Africa, and more importantly, not just the farmers, but their entire family. So with what lens are the leading economies looking at impact investments? Is it the same lens that India should be looking at impact investments too? The answer is no, because every society constitutes of a different set of problems. To simply add to the context that we are in, everyone currently is aware about the way US dealt with the pandemic was different from the way UK dealt with the pandemic, and that was completely different the way India dealt with the pandemic. And in the same manner, the different economies and societies have a different concern. So in this case, while the challenge remains the same, but the kind of scope of these challenges is completely different across different economies. And that's where our role is. We cannot directly pick up something from a developing economy and put it into our economy. We need to kind of tailor it out. We kind of figure out what are the challenges that we are facing as economy, and then use it for our benefit. There are few challenges which are common. For example, climate and sustainability is a global challenge. But there are, to cite some examples, movement like Me Too and other such events have stirred different issues. BIPOC investments. So BIPOC is an acronym for Black, Indigenous People of Color. Now, this kind of investment is something all investment companies are looking for as an impact lens across in the Western countries. Another is gender lens, having higher women entrepreneurs leading the way, getting the funding, being able to voice at different boardrooms. These are few of the many I have worked across in my exposure to the impact investment in UK. But honestly, India has a different way of looking at impact investments because it has a different set of challenges. So what could be probable examples of these challenges? So India has to focus on clean energy, eco-friendly products, financial inclusion, ag tech, which is the agriculture and blending it with technology, health tech, edu tech, and how to leverage all of these sectors and weave them with technology in order to reduce the rich and the poor gap, penetration into the rural India, and offer them an access to a larger markets. I know of a startup which spinned out of GUSEC, which is the familiar, I'm sure you might be familiar with them, which is the incubation and the accelerator nurturing startups, right? The founder of this startup is a young female. Amazingly, she's under 30, a management student who went abroad to study entrepreneurship course. She returned back to India because she realized that she wanted to give back to her country. When she came back to India, she realized that fast fashion is something which is harming the climate. And she decided to cater this issue with her startup called AltMat, which stands for alternate material. Now, why is it important, or how is it different, and how is it creating an impact? So basically, AltMat is using material and the sciences to offer sustainable proprietary technologies. They transform the waste from plants like hemp seed oil, pineapple, or banana, or industrial hemp, or nettle. They convert them into natural fibers and yarns. The application of these things range from industries to consumers. So for example, they recently have been in talks with the Indian Defense to use their material in designing uniforms of the Indian Army. Recently, the startup also got innovation and recognition award from the Circular Fashion Summit, which is organized by the European Union, and that is where it is open to design fabrics for the future fashion trends. The startup is young and just achieved break-even, but the kind of achievements that I just mentioned about and the speed of the growth are in no way less compared to any conventional profit-eyeing manufacturing unit out there. So that's how it is creating impact as well as generating profits. Both of the things go hand in hand. So what is the grip on a global level which is being made? So it's not just that the startups and the investors are present. There are also structures and bodies which are made in order to facilitate and in order to penetrate these impact investment space. Organizations across the globe are working towards this in a unified way. So there are 7 sustainable development goals, which are laid down by UN General Assembly, abiding all the member countries to work in that direction. There is also an organization body by the name of GIN, which stands for Global Impact Investing Network. It has been established to basically scale and guide effectiveness of impact investing around the world. Not only does it offer network, but it trains researchers, educates, and also kind of penetrates the impact investments space. India also has Impact Investor Council, to facilitate the research and support needed in this direction, but to stir up the matter. As indicated by the International Financial Corporation, IFC, there is a 2.5 trillion annual gap in the funds which are needed to deliver the SDGs by 2030. The shift in the investment focus has profound implications. What can we do? Where can we fit? Imagine if all the financial assets which are being held by the institutions and the household around the world, which is estimated to be roughly 269 trillion plus, were invested in the goal of having an impact beyond the financial returns. Imagine what difference would it make? So looking at what it is now, things may be expected to change in a progressive direction in not very far future. Generally accepted accounting principles may go hand in hand with generally accepted impact principles. Investors will have access to increased public disclosures on how institutions and impact funds are managing their investments. There will be more structured disclosure frameworks. Investor will be able to compare the results and then benchmark them against emerging best practices. Because at the end of the day, we are not talking for you to kind of alter your bottom lines. No, you have to work along with your bottom lines and create an impact. And that is where you should have things where you can compare it to the traditional setup which is there. And that is where these kind of governance practices or these kind of public disclosures which are structured and organized will definitely be of value. Company may publish 2 sets of accounts. Employees may want to work at a firm where they can have the impact weighted profit, and they may only decide to work if it is a certain percentage. Consumers will look at the same number before purchasing, and the investors may also do the same. Before I discuss the way forward, let me touch upon different terms which are popular or which are kind of used in an overlapping way in this space. So one of them is SRI, which is socially responsible investments. The second one is ESG, which is the economic social governance. And then there is this impact investing. So like I said, there is a lot of overlapping there, but let us understand how are they different. So SRI, which is the socially responsible investing, is basically looking at those investments based on a certain value of you as an individual or of as a fund, as an institution. So for example, if my value is that I do not want to invest into those companies which are in the production of tobacco, because I believe that tobacco is harming the society, or if the fund or if a company or an institution believes that it is harming the society, they would not want to invest into these kind of funds. So here you are being socially responsible by eliminating all the things which your values or all the companies which your values suggest you not to. So how do you eliminate? On what basis do you eliminate? So that is where we are talking about using the ESG framework. So ESG, like I said, is environmental, social, and governance. So you use this framework or this data to basically identify that which companies are suitable for the socially responsible investments. So basically, impact investment is including all the investments which you feel are creating some kind of impact. And now that you feel thing is changing from you feel to established way of creating impact versus the socially responsible investments, which is eliminating those investments which are not socially responsible. The way forward, according to me, can be the financial tools, and those could be into 2 categories. One is to design the securities, which is the funds or the bonds, whose return is derived by the impact it has created. So more popularly known as social impact bonds or development impact bonds. That could be one way of looking at it. Second could be that we could start to measure the impact within already existing traditional disciplines. So for example, instead of private equity or venture capital that is already existing, we can now look at it in the lens of impact. So for example, impact private equity, impact venture capital, impact real estate, impact infrastructure, so on and so forth. Interestingly, pension plans have a special place in this, because generally they are for a long term with the tenure like that, and that is where the movement into the impact space actually starts happening. To have a better grip on governance and reporting measures, which again is one way to kind of increase the faith of individuals and institutions onto the impact investments, is to have more profound governance structures. So that is where GIN has come up with a framework and the metrics that dictates how the reporting should be done. And measuring and managing the impact in this way would definitely encourage trust of the individuals as well as the institutional investors who are looking into plunging into the impact investment side. Impact reporting and investment standards, which is acronymed as RIS. This helps investor take informed decisions through reporting standards, and it also sets up a tone for governance for the shareholders. The risk that too many people would jump into the impact investment space to have a share of the pie. They may jump in with no background. So that is the risk most of the impact investment experts who have been into the space since years are worried about, or they find it as a risk. Also, like conventional finance, it may leave the decision of allocation in the hands of few and not diversify or inclusive, which is the very purpose of having investments with the impact eye. So those are the risks, and I leave the platform requesting the students to come up with some kind of a framework or some kind of a strategy in order to how to outbeat this risk. Also, the measurement of impact returns and how you're creating an impact is falling into structure, but it definitely has a long way to go. Especially with developing countries like India, where we are still trying to figure out what impact investment is. It definitely has a long way to go, but that would also potentially mean a lot of impact washing. And definitely experts in this space advise that if they want to reduce the intensity of impact washing, having a structure in place, having policy in place is exactly what needs to be done. And we cannot solely rely on the government as well to frame the policies. Being into academia for 6+ years and now as a practitioner, I can foresee a lot of collaborative opportunities. Universities here at London, like Oxford, offer a detailed course for people or professionals who are interested to pursue impact investment domain. So does Stanford and Harvard. I'm positive Gujarat University, which is known for fostering research and innovation, also Dppg, with its experience in policy framing and governance, alongside the entrepreneurs and the professional investors, can join hands and march along the path to address this challenge. I'm requesting, or I'm urging all the people representing GU and the department present here to take some initiative on this side and mark torch bearing effort. We at Supiva Advisory Group Limited act as a handholding and advisory platform for startups who want to raise impact capital, as well as institutions and individual venture capitalists and private equity investors who are looking to fund impact startups. So all of our startups whose capital we raise and the fund collaborations that we have are fueled by impact in gender lens. I hope with this talk I could offer some food of thoughts for all of you who are listening to this talk, and also an international context to all the listeners. Once again, I thank you for the opportunity. Thank you very much.
Thank you so much, ma'am. Thank you so much for bringing a social point of view by combining finance and the startup industry. And thank you. I thank you on behalf of all the students for encouraging us so much. And you have given us a very good point of view and some good insights to think about. So it was an honor having you, ma'am. And now I can see Chirag sir here.
Yeah, I hope now I'm audible
Yes,
and
sir.
it
You
all
may
works fine.
continue.
Okay, thanks so much. I'll just share the screen. I've changed my device and I hope things work out now. So Purva, just let me know once you're able to see my slide.
Yes, sir.
It's visible now?
Yes, sir. It is.
Perfect. Okay.
Yes.
Yeah, thank you so much, Purva. Thank you, Dr. Panchal, for inviting me. Just a correction, Purva was very charitable in my introduction. I actually don't hold any doctorate or I'm not a professor. I work for a prominent private bank in India. And I hope I'll, as my earlier panelist told me, leave some food for thought for the students here. It's almost lunchtime, so I'll be crisp. I have a short presentation just to throw some light on what's going on in the banking sector in India during this pandemic. While we talk of the pandemic, I just thought that throw some data. Most of us are aware India is racing fast towards becoming one of the most affected countries in the world. Surprisingly, from where this all started, seems to have the minimum effect. But nonetheless, that data, we all need to see how far that can be true. Giving just a global perspective of the economy on what's happened in last 1 or 2 years. This is a good overview. I'll come to India a bit later. I thought to give you a global perspective. It will be nice to show that what happened in 2020. As one of the panelists told earlier, that it is a black swan event, something that is not known. It's an unknown. Nobody can possibly prepare for this kind of event. Not even at a personal level, not even at an enterprise level, not even at a government level, and surely not even at the social level. But nonetheless, we are in this situation, and as far as GDP, global GDP is concerned, there was a big dip in 2020. But surprisingly, the way things have worked out after 2020 in late last year and in the early part of the current calendar year, most of the economies, and that includes India also, which I'm going to cover it in next few slides. Most of the economies have bounced back. Of course, the numbers that you see on the slide, it has a base effect thing also, wherein your previous year GDP numbers were so low, and that is why this year GDP numbers will look quite above average. But as far as economies are concerned, most of the developed economies and all, they have kind of bounced back. The numbers which are coming out of US, which is engine of growth for the whole world, has been impressive. Next slide is on what happened towards unemployment front globally. There was a blip in between in the middle months of 2020, and situation more or less has been come back on the rail, especially again with US, which is a big indicator of what goes on in the world, followed by some countries in the EU. Employment figures have kind of showing coming back on track. This is where I was trying to hint that things have come out quite well in 2020 on the economic front globally. Various bodies, let it be the World Bank or the IMF or the OECDs, they have given their forecast of various geographies, which you see in the second column, what things were in 2020 and what they are likely to be in 2021. So a common factor across all geographies and by all forecasters have been the same thing, that 2020 was, of course, everything was in red, but 2021 we think things are bouncing back, and perhaps what the pandemic has taught us is given a new direction in terms of personal behavior, in terms of enterprise behavior. A lot of new things which were not possible before are now possible now. There is an excellent resilience amongst the IT sector, which I think Dr. Dhananjay had shown in his presentation also. Things companies like Amazon and any other e-commerce companies you would see in the world have done exceedingly well. You would correlate that with our own behavior. Now, most of my purchases for my household have become online, uh, even for daily groceries or vegetables or something. So, there has been a tectonic shift in what is now important and what it used to be earlier. Coming to India, this is quite a drastic fall that we saw last year. This is FY21 Q1, which you see a huge red bar, which was the first quarter of the previous financial year. This is when the complete lockdown was announced by the government to arrest the spread of the pandemic, and that had a cascading effect on many subsectors in the economy and for a little bit time to come. But good news is within 3 quarters, India has shown excellent resilience. We are officially out of the woods now. We are no more in recession. The Q3 numbers, which is the quarter ending December 2020, has been positive, in the positive zone, albeit marginally. And I would assume that this positive trend would continue in the Q4 numbers, which will be published very soon. 2022 financial year 2022 seems to most of the forecasters are perhaps hinting GDP growth between 8-9% to even 12-13%. But certainly nobody had counted what is going on today. We are seeing the numbers and we know the situation on ground. So the impact of what is going on today nowadays is yet to be assessed. So I'll come to a little bit on what was done by the central bank during this whole phase. Just to give an idea, I don't want to get into too many of technicalities. Sorry, before that, I somehow jumped one slide. So yeah, on the central bank front, various measures were announced, were taken to help the liquidity, to support the investment in economy. One of them, the repo rate, which is the main instrument, the main tool for the central bank to govern the interest rate and possibly a bit of liquidity in the economies through this repo rate. Already, you would see that since mid 2018, this was on its way down, and the RBI was not shy to bring it further down. You would see in the later part of the graph on the right-hand side corner, towards the mid of 2020, early 2020s, this repo rate was reduced further to 4%. you would have possibly noticed the effect of this on various counts. The most common, I think, as an individual, we are more aware about housing loans rather than the interest rate scenario for corporates. So on housing loans, something that we had not seen in last 15 to 20 years, the interest rates on the home loans have gone to those levels which were possibly seen earlier in 2005 or even before that. So currently, as an individual, we are able to borrow at sub 7 rates. Some banks are canvassing at 670, 680. I'll just pause here just to make sure that I'm audible and everybody's present. Purva, I'm there.
Yeah, everything is
Yes,
fine.
sir.
Perfect,
Yes, you are
perfect,
both.
perfect, perfect. Right. So I was mentioning about home loans. This was housing happens to be a very important ingredient of our economy. Supporting the home owners, the home buyers, and indirectly supporting the construction sector, which is a big contributor to the GDP and employment in India. That was one step taken by RBI. On the ratios, both CRR and SLRs were reduced further to induce liquidity in the banking system, which later on gets percolated or transmitted to the economy, to various borrowers, as banks would have more funds on hand for them to lend. This is just a small summary. I thought, although RBI has taken many more steps than what is there on the slide right now, it's just a small summary of main things which were done. Policy rates we have already covered, how the repos and the CRR etc. were adjusted to induce liquidity and bring down the overall interest rates in the country. A very novel step was taken by RBI to allow banks to provide a moratorium to borrowers. Moratoriums are somehow, we can, in a very basic terminology, we can call it a holiday for the principal or the interest payments. The borrowers were allowed to first postpone their EMIs, and for the corporate borrowers were allowed to postpone their principal and interest payments by 3 months, and later on it was again further extended to another 3 months. Second wave measures is what was announced just a few days, so I thought I'll spend a bit more time over here because this is more relevant as to what RBI has done just about a few days back. 50,000 crore liquidity was enhanced, was provided for up to 3-year tenor. This was very focused approach for letting banks to lend money to the vaccine manufacturers, to importers of vaccines, to importers of medical devices, hospitals, labs, even manufacturers of ventilators or oxygen concentrators, etc. So this is the most direct way I have seen RBI has come in to aid and help the situation, what is going on the ground right now. We all are aware. I don't have to explain how this will help. At the same time, a special LTRO, which is a targeted TRO instrument for 10,000 crores, is given to the small finance banks. In turn, this will be small borrowers, small business owners, which up to 10 lakhs per borrower will be allowed, at a easy finance, as an easy finance option available. So overall, RBI has always been one of the finest central banks, I would say, all over the world in terms of you take management of liquidity or the monetary policy or even the currency management. I think this time also they have done a good job Of course, this is always debatable. So this is more or less, I thought, just show direction to all the students here, not going much into a lot of technicalities. I think much of the concepts were already covered by my earlier panelists. So I'll more or less conclude here. I'll take the questions, but before that, I thought, although it is a bit off topic, I'm addressing you guys today. Not long time before, I was in your seat with Dr. Neelam Panchal. We studied together in our MBA. And one thing I thought I'll communicate this to all students here, that invest one ingredient in yourself, which is very important, which somehow gets overlooked in our preliminary and on higher education, which is on developing our communication skills. And this is where I have picked a few three quotes from Warren Buffett. I'll just take a minute here. It's off topic, but I thought this is important, and I'll just convey this to you. So he has mentioned that there is only one investment that supersedes all others, which is invest in yourself, which we do quite well as students, learning the topics, learning the theories, all the ratios, as whatever is there in the book. But at the same time, we need to invest quite well in the communication skills. The second quote is one of my favorites, which I also always make stress to my team or any new joinee in the company, in the bank I work, that if you can't communicate and talk to other people and get your ideas across, you are giving up your potential. If you have an idea in your brain, it is an awesome idea in your brain. It is equally important that you know how to keep it across on the other person. And another quote at another given point of time by him is, you will be perhaps 50% more worthful if you add those communication skills to your basic technical skills. So that's it. I hope the presentation was interesting. I'm available for questions anytime today or anytime later. You can contact Dr. Panchal for that. Thank you so much again.
Thank you so much, sir, for bringing so much clarity to everybody present here. And thank you so much for the way you concluded your session by helping us and telling us more about how communication skills are actually very important in the real world, as most of us here are about to step into the real worlds very soon.
Right.
So
yes.
Thank you so much for those insights, sir.
Sure.
It
Thank you
was
so much.
wonderful listening to you. Now I request everybody to, if anybody has any questions, they may go ahead with it for any of our panelists. There is actually one question that I got personally on my phone. The question is by Meet Vora, a student of Dppg. The question is, how does US bond yields affect Indian stock market?
Yeah, should I take this, or this is for any particular panelist?
It is not for any particular panelist, okay, so you may
fine.
Go ahead.
Yeah, again, not going much into the nitty-gritties. Ours is a very small economy and a stock market per se in terms of volume still. We are a large nation, but if you compare the volumes and the size of the market globally, and especially for other developed countries. So what happens is the major chunk of investors are the institutions. Although in last 1 year, we have seen some retail participation also. And within those institutional investors, the foreign investors, they constitute a large chunk of what money comes into the country. And often you would have seen headlines that FIIs have invested so and so on this day, and the market was up by so many points. So their behavior and their investment becomes a big indicator as to where the markets are heading. Now, so coming to FIIs, what makes them invest in India? Everybody invests only for one thing, is money, and to have handsome returns on money. When a foreign investor will look at investing in a foreign country like India, the direct comparison is made with the interest rate lying in your home country. A very simple example for you is if somebody gives us a business proposition that let's start up a new business, and we are going to make some 10% return on our investment. Most of us from Gujarat would say 10% is enathi to su thai, 60% ma to FD aapse mane, So this is what a foreign investor will also look at. As interest rates in US were at an all-time low a few years back, I think it was yield was some sub 1.5% or something. It was as good as free money, and deploying those funds globally, let it be India or any other economy, was a very straight decision. That money is cheap here in US. Nobody can think of investing in US because of the yields are so low. Let me invest somewhere out. And now when those yields are going up, the edge that a foreign country investment would have will get reduced, and there will be some balancing which will be done. So there is a very subtle way how this works. You will not be able to possibly on a day-to-day basis relate that today what is the interest rate in US and how much investment is coming into India. But as I said, it is very subtle. It's as a theoretically saying, if interest rates go up in US, you will see FIIs less interested in any country, including India.
Thank you so much, sir, for taking up that
If
question.
I may add here, with the permission of Chair,
Yes, sir.
see, the advantage to the FIIs investing in US itself, they are not having any exchange rate risk. So that drives them. So if the rate goes there up, if they invest in anywhere else, or especially India, so the return may be 10%, but the exchange depreciation may adversely affect them. So the exchange rate, they are insulated of the exchange rate risk so far as the investment in US is concerned. So if that happens, they are more attracted to that. So at least there is a certainty of them, unlike investing in India. That could be one of the points. Thank you.
Thank you so much, sir. Now I like to call upon Neelam ma'am once again to propose the vote of thanks.
Any questions to any students? Before that, since all the speakers are here, can we have a click? It's also camera should be on.
Ma'am, pictures have been taken, ma'am.
Okay, thank you.
Yes.
So thank you so much. It was really a great start for us, because keeping in mind that rather than just being in a class and giving all routine, we thought that why not to organize this management conclave series, whereby I can call stalwarts like you and can provide something different and something important which is going on in this world. And so that is the first initiative that we have tried to taken, and that too with the International Finance Conclave. Being a finance faculty, more touch and more interest in finance, so why not to start with finance. So that's how we have started with this. So thank you so much, especially starting with our Vice Chancellor, Pro-Vice Chancellor, Registrar of the Gujarat University for giving free hands to us to organize whichever event we want to. Very special thanks to our director, Professor Pratik Kanchan, who has already given us free hands for all the activities of the department that we want to organize in our way. Importantly, for today in the International Finance Conclave, I am very thankful to Mr. Piyush Gandhi, Senior Vice President, Finance and Accounts, GIFT City. He's also in the board for the Dppg, and thank you so much, sir, for your beautiful insights on the corporate finance. And
thank you for having me here. It's my privilege to be with all stalwart speakers.
Thank you so much from the bottom of my heart, Professor Shantanu Mehta, freelance academician and adjunct faculty, Nirma University, for your wonderful insights on the finance and the financial management, and then how the scenario has changed and what the students should look for and think about, so that they can go in a practical scenario. So wonderful words, and thank you so much.
Thank you, Nilam ma'am. Thank you.
M. Subramaniam, Head Management Programs, RL Institute of Management, is also having a very good background since the time of IIM FDP. Since 2012 we are connected, and having a very great background in the financial market, and he's also connected with the SEBI, and wonderful insights on fintech in India and the blockchain fundamentals he has given. Thank you, Dr. Subramaniam, for being over here and spending time with us. Thanks goes to Dr. Dhananjay, Dean MBA from Narayan Engineering College, Nellore, for wonderful insights on Indian capital market and global crisis across due to this pandemic, and how the financial market is looking forward and how it can be revived. Special contribution by Professor Narayan Basre. He is also professor from School of Petroleum Management, PB, EU. Thank you so much, sir. And it was great, like listening you after a long time, and that too with such a wonderful slides that you had in the presentation, and the way you tried to take the topic and justified the title. So we are very thankful.
I may add, madam.
Yes,
this was
sir.
really scholastic, and perhaps one of the best presentation, completely faithful to the theme of it.
Exactly.
Thank you.
Exactly.
Good.
Shantanu sir, actually, it's your blessing, Shantanu sir. It's your blessing.
Thank you. That is what Niyati
Sir,
tells
it
you.
was a good presentation and very colorful presentation.
Very nice, very attractive, very colorful, very focused, and specifically on the theme financial.
Yes. Very much
So
faithful
thanks
to
so
the
much,
theme.
sir, for your contribution. We thank Ms. Niyati Dave, Associate Supriya's Advisory Group Limited, straight away from London, UK. She has joined over here, and it was again wonderful talk on the impact investments and her own experiences. And we were very happy that we were also connected with Verma, and the way she has changed after, and even the accent, the pronunciation, the way she talked on, and the way the justifications she could give on the topic. I'm very thankful to you, Professor Dave.
I send a separate message to her. I am very happy to see the complete transformation in your personality and going away much broader from the limited knowledge of the finance. Really.
Yes, sir. I thank Mr. Chirag Gyara, a professional from banking and financial services, for your wonderful insights on what is happening in the banking and what are the challenges in the financial services, and so on and so forth. So thank you so much, and special thanks to all my group students who are here since morning and who are managing these shows, IT part, videos part, and anchoring and whatnot. So without your active participation and active coordination, starting from designing of the brochure to making the videos, to anchor, to coordination, to IT part, and even after this, there'll be so many things like distribution